We are driving back from Camp Kotok. I am joined by Tal Smith, the New York Times. Tal, you were just saying that contrary to a Bloomberg opinion piece, that the stakes are so high for Jay Powell that actually the stakes are lower than they've been for a while. Tell us what you mean by us. And by the way, as you drive down the 95, welcome to Forward Guidance.
Thank you for having me. Yeah, it's this odd position that we're in right now where this is the moment that we've been waiting for. That not only has the Fed reached a terminal rate in terms of how high they'll raise interest rates on the short end, not only have they rhetorically pivoted to there being a balanced set of risks, markets are now fully pricing in not just whether they will cut or not, but how big the cut will be and how many cuts will there be until they reach what they think will be the neutral rate. Fundamentally, we know the direction we're going in. To the extent it's mission accomplished, they've gotten the labor market clearly back into balance, and that liquids rate, that employment. And so now we're in this sort of awkward, somewhat exciting, but not super exciting wait and see moment where retail sales and jobless claims have shown that hopefully the tick up in unemployment that sparked the triggering of the Sahm rule, that it's hopefully for the good of the country and for good of workers, a false alarm. We don't know. And I think just people of good reason and goodwill, and probably people in the FOMC are hoping that the next few months are boring. Obviously, politics will be very exciting, but in terms of just the economy itself, you hope that unemployment doesn't go very much higher at all. In fact, I think some people, including me, would hope that unemployment ticks down in terms of U3, and that inflation remains contained, that finally OER, owner's equivalent rent, rolls over. We've been waiting since forever. And yeah, all of that together, it's exciting to the extent that we're piling up good news at the moment that we're all very worried, whether you're in markets or whether you're looking at just the labor market. Bad news, but in another sense, we're just chugging along here. So yeah, in general, monetary policy, the largest country, the largest economy on earth is high stakes, but we're in this weird moment where because the outcome is so heavily anticipated, I actually don't know if it feels as high stakes as it might otherwise. How's that?
That's good. And yeah, I'd say you said the bond market is pricing in all these cuts. The bond market has been fighting the Fed the entire way. The short-term interest rate structure, I should say, from 0 days, 1 day to 2 years, and been pricing that the Federal Reserve is not going to hike as much as the Fed says. It's going to cut by way more. The Fed says they're on pause, but we're going to price in 6 cuts. We're going to price in 10 cuts. This time it's different. The Fed has signaled it's real this time. They're going to be cutting. It's very likely going to be in September. They see that the economy is slowing. I don't know they would use that word. They would say the labor market is cooling. Things are coming into better balance. They have a certain way of saying things. But yeah, the incredibly hot economy of 2021 and 2022, particularly in terms of nominal growth, 2022 was not a great economy. Real growth was negative for 2 quarters. And by the way, for everyone listening, Tal knows a lot more about this than I was, but nominal growth was insanely high. So inflation plus real growth, that time is no longer with us. Inflation's at 2.9%. There are some rumblings that real inflation could be a little bit lower because that's year over year, and owner equivalent rent is very lagging. But yeah, the Fed is going to cut. And Tal, we just were listening to Bloomberg Surveillance. They were saying how the theme for Jackson Hole is something to the effect of the transmission mechanism of the Federal Reserve's monetary policy. And what that really means is, as I interpret it, just how quickly and how intense and how potent is the Federal Reserve's ability to affect economic and financial conditions with its interest rates policy. It also has its balance sheet and quantitative easing. Let's just stick on interest rates. Back in the good old days, and again, I always say I'm wary of looking at the golden age of this, and it's this mistake to look back at this golden age that never existed. But back in the golden age, Paul Volcker would raise interest rates and there would be a recession quickly, or things would slow down quickly. And we are close to 2.5 years after the first Federal Reserve interest rate hike, and we are not in a recession. It's possible we could already be in a recession. I can't say absolutely that we are not in a recession already. Like, I look at the back tests and I see anytime recessions simply start when unemployment is low and has been going up a little bit and then start to spike up, and it spiked up. Tal, as someone who has a way higher standard for objectivity than I do, I'm just a podcaster, can you say that we are not in a recession right now?
I do not think that we are in a recession right now. The nature of a recession is that people lose their jobs and the economy, overall commercial activity, contracts over a period of time. And the tricky thing about that is, if that is the case, if that's how we define, it's not really we, it's the NBER that decides that. If that's how the NBER dictates when you do or don't have a recession, then we could be in the very early innings of recessionary conditions if things like unemployment continue to tick up, if the housing market stays as frozen as it is. But then weirdly enough, if the economy gets enough juice flowing and animal spirits and markets, and in terms of capex from the small business down the road up to corporate America, publicly traded S&P 500 companies, then you can very quickly come out of this sort of gully. And then what turns out, something that started as the early innings of recession turns out not to be a recession at all. And I think that's the ball game here. The whole time, people looked at the 70s and they thought, okay, essentially the most important commodity in the world, oil, went from not being very expensive at all, so inexpensive that most of the time people didn't think of it. And then it went up 10x, and then things seemed to calm down for a bit. Obviously, we were a much more unionized economy then, so workers got a lot of raises in that early to mid 70s period. And so the Fed made a dovish maneuver. This is the Burns era. And
75 to 79.
Yeah, and then things seemed like they were in place and things seemed like they were okay. And then it turns out that you got a double spike in inflation. That's obviously what the Fed has been worried about. I've spoken off record to folks that are on the FOMC, and that's a concern they have. I don't think you have to have spoken to them off the record to know that, or to be talking with market participants. And I think the string of data that we've seen, the last 3 months have been about as good as you could hope for in terms of the price data. I think my colleague Ben Castleman at the New York Times, when the CPI data dropped, pointed out how good the data has been in the last 3 months. I think something like the 3-month annualized rate of inflation it's below 1%. Now, of course, we have to be very careful.
On an annualized basis.
On an annualized basis.
Wow, okay.
Yeah, that's how soft the prints have been. I believe this is on CPI. You got to be careful with that because we saw 3-month annualized prints that were amazing in both the third quarter and the fourth quarter of 2023. Then obviously we got the stinker that was Q1. But I think now there's this creeping sense of, okay, like maybe we're out of the woods. Maybe it is true that we could have immaculate disinflation. Maybe it is true that what you started this out with, we can avoid a recession. And that doesn't mean that the world's problems are solved, but it is a big effing deal if we experienced a pandemic and a land war in Europe, and we come out of it with GDP above 2.5%, the unemployment rate low, and business investment growing. I don't think you risk being irrationally exuberant by saying that's a really good outcome if that's what we're able to pull off here.
And I think once the Fed started raising rates, the economic vibe, of which I was very much a part, was so negative in terms of it's impossible that there can be a soft landing. That is literally a thing people said on Bloomberg, probably on my show. And if you start with the view that it's impossible that there will be a soft landing, then the economy that we've had since March 22, when the Fed raised its rates, which I think has smelled like a soft landing and has quacked like the soft landing. That's why the stock market, if you assume the worst and then it's actually not that bad, you'll be rewarded by taking that risk. In markets, Tal, you're very locked in on the labor markets. And as we drive back from rural Maine back to New York City on our drive, up here, you said to me something that actually surprised me about how you speak to economists and recruiters and people who work at very large recruiting firms, very involved in hiring. And they say that they are waiting on the Federal Reserve to cut interest rates before they hire people. And that is surprising because I typically think, okay, the Federal Reserve is in charge of interest rates. And in general, when they cut interest rates, it's stimulative. And when they raise interest rates, it's contractionary because everyone wants a 3% mortgage and fewer people want a 7% mortgage. But its impact on the labor market is very indirect. And according to this series of conversations that you've had, there are people who are waiting to hire people and they're waiting on the Federal Reserve.
Yeah, I think the stereotype of the average American business person is that they're just some hillbilly that isn't paying attention to the weeds of macro and Monpol and stuff like this. And that who knows whether they know whether interest at 2% or 5% or if they stayed at zero. But it's no, like business people of all types are obviously paying attention to the cost of credit. That's a big part of running a business. It's in the same way that people that look for homes, past, present, future, will be focused on mortgage rates, basically the 30-year fixed. And that's part of why when you take home prices going up or how much they've gone up, and you pair that with mortgage rates being as high as they've gone, that's part of why we've had that vibe session. But business people want the security of knowing that they're going to do CapEx, they're going to do investment, they're going to open another branch of their chain, they're going to do another wave of hiring, and they're going to do that going into an extension of an economic expansion. If you decide to expand your business or hire a bunch of people, and it turns out the Fed is still worried about inflation, and so they're still willing to put the economy into a recession, then that's a bad business decision. So of course they're worried about it. Now, I say of course, maybe that's overconfident. I'm saying this in part just because this is what I've heard. And yeah, I don't know why, but Jack, this entire trip, somehow we keep coming back to the idea of a dude that owns 7 laundromats. There are more small business people than the guy, and you name it, town America, that it's not just laundromats out there in the country. There's plenty of good businesses of different varieties. But yeah, let's say that you're a restaurant or a coffee shop that's been doing pretty well. You have 2 locations, you want to have a 3rd location. I think that's completely rational for those people to think, let's make sure, would they use the language of, is the Fed going to put in insurance cuts that extend the cycle? Yeah, no,
they're not saying, I hope the Fed does 50 basis points in September.
I do not think that privately held businesses are thinking about R-star and the very precise terms that macro nerds do. But there are plenty of folks out there that are aware that we were at this pivot point in the cycle, and like everybody else, they're hoping for the best, but they're being cautious. And I do think that if, to use the words of the LinkedIn chief economist, they're waiting for the directional green light that it's okay to go ahead and make those new investments and make that new start hiring. As our buddy Sam Rines, an economist and a strategist now at Wisdom Tree, said, if all works out and the Fed gives that green light, it's game on. And I think that'll be really positive for everybody, from small caps portfolio managers to whatever else, your strategies and markets, to small business people and to workers that are currently on the sidelines but hoping to get hired. So yeah.
And I think what we're talking about is just how important short-term interest rates are to the economy. And what folks have been saying over the past 2 years is, well, the Federal Reserve doesn't have that big of an impact because it's all in the 10-year. That's where, Apple is issuing 40-year bonds. The high yield bond market is priced off of long-term Federal Reserve expectations, as well as growth, inflation expectations. But the short-term interest rate doesn't really matter. And that's why this cycle has proved way more resilient to the Federal Reserve interest rate hikes than we thought. That's why we haven't had a hard landing, at least apparently. And that, I think, according to what we heard in Bloomberg Surveillance, is something the Federal Reserve will be talking about at Jackson Hole, which again is a academic conference that just happens to be public. It
just happened to import TV studios to Jackson Hole, Wyoming.
Yeah, the cameras just happen to be there. There are lots of academic papers and I think that's something central bankers are going to consider, is just how powerful are the tools that we have. And I think, so the discourse over the past 18 months has been, they're less powerful than they thought. Tal, earlier we started recording, you said to me how net interest income for the private sector is actually up because yes, they're paying more on their debt, but they're earning more on their cash, and everything, once it cancels out, their net interest income is, they're paying less in net interest expense, I should say, than before the Fed raised rates, which really is crazy to think about. But I do think that, and maybe I'm totally wrong, but I think that, okay, you have wealthy people who got all their mortgages at 3% in 2020, and they were savvy, they had the means to do, they had the financial know-how to do so, and they had the ability to do. Making wealthy people that much wealthier is not very stimulative to the economy. Likewise, Apple, Amazon, they issued 40-year bonds, 50-year bonds, longer duration bonds than even the US government borrows at. And okay, they're benefiting from that. That helps them. Delta, which had to be, the word bailout is politically charged, but bailed out by the US government and issued very attractive and available financing when their entire business shut down. They are now paying less in interest expense now than they were, at least in 2023, because they've been delevering. So the private sector, these large corporations have not been impacted nearly that much. And if anything, they're doing even better, which if you told me that 2 years ago, I would have thought ridiculous. But Apple, if they're crushing it versus they're really crushing it, how much marginal extra employment and consumption are you going to get from that fact versus the laundromats, which do not have access to the bond market, and they borrow from banks. And that bank rate is based off of SOFR, probably 3-month SOFR, which is extremely correlated to, that's literally December right now, or November. And that is extremely, extremely related to the Federal Reserve. And I also think that the business economy, small business might have become very levered by private equity, where these laundromats, and I think this actually is a thing, private equity company, they raise all this money, they have to put it somewhere. We're going to buy laundromats, and we're going to buy more laundromats in a roll-up, and we're going to get a high return, and we're going to be super efficient by borrowing money, and that leverage is more expensive. And I think the private equity companies, their stocks have actually been on a tear, both because the economy has been so much better than expectations, and because they have private credit arms that have benefited from rising rates, and they've raised a ton of money off of that, and maybe they're hiding a few things underneath the rug. That's only speculation. People are saying it. We'll see.
Yeah, we got to be careful. We don't think people are actually laundering in the laundromats.
No.
Yeah.
But private equity is not mark to market, and the businesses could be doing less well than the previous mark was in March or December, versus if the laundromat was publicly traded and the stock market crashed 60%. So that's what I mean.
Yeah, no, I think that's a really interesting, I don't want to say problem, but like issue. Does it present a systemic risk? There are a lot of smart, very well-credentialed people that say yes. There are a lot of smart, well-credentialed people that say no. To your point, there are a lot of people, not just the wealthy, a lot of middle class and working class folks that have mortgage rates in either the high 2s or the low 3s. And it's the best inflation hedge that probably exists on planet Earth. And 2/3 of American households have it. And it's pretty damn hard, even when the going gets tough, to plunge into a recession when everybody is employed and everybody has, not everybody, a lot of people, the majority of the country, in terms of households, not necessarily individuals, but in terms of households, has a 30-year fix. Now, without rubbing too many people the wrong way or getting the stuff that we don't want to get into, who created the 30-year fix? The US government. And they also literally helped Wall Street securitize it and make it something profitable and worth investing in and trading. So it's not just the more recent interventions into the economy that the government did during and coming out of the pandemic that may have staved off a recession. Just even the way that structured our economy. And when I say we, I'm talking about
You and me, we control.
Yeah, literally Jack, Farley, and Talmon and Jack. No, our policymakers, our elected policymakers, obviously the Fed's at a distance, right? The Fed chair is elected in some very indirect sense that he's appointed. A lot of these positions are, Senate confirmation dependent. But we have done a lot of things wrong in this country. But some of the things that we've done right in this country, going back to some historical coincidences, like deciding that after the Depression, we want to create things like a 30-year fix, and then deciding that even after that, we're going to make it something that is highly investable. Some of that stuff has worked out. And FDIC, good idea. And as I don't have opinions, but just based on the weight of the evidence, it seems like an important institution.
Wait, so are you telling me that the Federal Reserve being able to control interest rates with all its flaws, is that you're telling me that's a preferable system to interest rates and the supply of credit being determined by how much gold is mined down in South Africa last year?
Yeah. I think the modern fiat world is superior to us connecting our currencies to various shiny rocks. Though when I go back and look at the folks that wanted the currency connected to silver and others that wanted it connected to gold and farmers arguing with folks, that's all fun stuff to look back on. But I think the world we live in now, where interest rates, the strength of the rule of law, and the stability of your tax system, that determines more of what a currency is worth, and calculating and trying to adjudicate where exactly whatever a neutral rate for a central bank should be in terms of how to control inflation while maximizing economic growth. That seems, like a way better system. It's a free country. Go forward, God bless. People are really worried about it, and they think crypto is a good way to hedge mismanagement of the economy by the US government. There are hedges for that, if that's your fear.
Hello, everyone. Permissionless 3 is coming to Salt Lake City on October 9th. The event for crypto natives is heading west, and we are bringing the biggest names in crypto together for an insane, can't-miss event. Hear from more than 200 industry titans, including Balaji, Mike Novogratz, and Dan Tapiero. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups and L2s, institutional adoption, and of course the November election that will be right around the corner. We couldn't be more excited about this event. Get your ticket today, and make sure I get some bragging rights by using my code FG10 to get 10% off. That's FG10, stands for Forward Guidance. I want to see you there. Do it. It's going to be at one of the most beautiful places in the United States, and everyone's going to be there. Van Spencer's going to be there. Jim Bianco's going to be there. Jan Van Eyck's going to be there. So what are you waiting for? Get your tickets now by clicking the link in the description and use code FG10. Back to the episode.
Yeah, I mean, I would never say that as the growth of debt goes up, that gold, it is possible that gold won't go up. It's impossible that Bitcoin won't go up, or make the even more dumber prediction to make in public, say that Bitcoin is going to go to zero, which is it's just you're going to look like an idiot when it doesn't go to zero.
There were some people that made that call, and I think they probably regret it.
Yes, all I'm saying is that an economy that has a hard money, that when there's a financial crisis or a recession or a depression, and it's in supply of currency, that will create deflation, and then prices will go down, and then a psychology of deflation will set in where you make money by not spending money, and then it goes even worse. I think we've learned from history that doesn't work. So yeah, again,
I get the temptation though, right? Look, there are plenty of folks I know who like the idea of it'd be awesome if housing prices went back to their 2017 levels, and I also had interest rates back at 2017 levels, or really actually as ideally 2019 levels. Yeah, that state of play sounds really attractive to a first-time home buyer. If you're a first-time home buyer now, it's a huge pain in the ass. So I get, and we see this online, it's on YouTube, it's on Twitter, people make like parodies that actually seem cries for help about this too, where it's, man, wouldn't it be awesome if the housing market and then like in stocks maybe went down too, and then we all buy in there. The problem is like, it's what would be perfectly calibrated for you as an individual isn't necessarily what would be better for everyone in society. And also, if you get deflation, if you get a percent correction in the housing market, if you get a GFC style, the market, that's not a market correction, market massive downturn, it's very unlikely that your life prospects won't also be affected. But one of the classic things people have said in this cycle that I think is just wrong, and I don't mean that in a mean way, this idea of, part of why inflation is so unpopular is everybody experiences inflation. Only some people, even in deep downturns, experience unemployment. And it's that's true. And it has this really snappy, neat formulation to it.
Good to say on TV.
Great to say on TV. Great to put in a newsletter. Great to put in a job report for the New York Times. And again, like I'm in part critiquing myself here because I'm almost certain that I said some form of that in an exposition part of a news write-up of this.
As in your voice or as a quote from a source?
I think that's why I can't exactly remember. Who knows? Either way, it's it's a legitimate point of view, and it's at least partially true. But like, the thing about unemployment being high is like, good luck getting a raise. Good luck getting like not just a job, good luck getting a good job. People our age, I think, sometimes forget that there were folks like fighting with others to get a job at Starbucks in the early 2010s. Like, that labor market off. There are people in my family who had white collar jobs, smart people, no criminal records, as normie of a good employee as you could possibly be. The downturn happens as big as and while, of course, if you happen to be the person that kept their job, had some investable money, and you bought housing prices at that bottom, good for you, and that's wonderful. And obviously we should all be happy for them and their family. It's also true that people in my family and people in a lot of folks' family across the country went from middle class to upper middle class stability to competing with other lower income working class workers for jobs just to put food on the table and just to make sure you don't get behind on a light bill or that you're paying off your statement on your credit card. So yes, inflation is annoying, but I think it's actually been political malpractice, and I guess they're wonks, right? So it's like not necessarily their job, but one of the biggest mistakes, like if I had their job up this cycle, is that the Biden team was never really able to adequately sell what's the point of low unemployment. Like, why is it so good to get back to low unemployment? And one of the easy layup points you could make is, I spent a lot of time traveling across the country, talking not just to people that run laundromats, or laundromat friends, but also workers of all types and families of all sorts. And nobody was leaving their job unless the grass was greener in the form of better benefits or better pay or better flexibility, maybe work from home. And that weirdly and it's partially my fault.
This is in 2022, right?
Yeah, 2022 and 2021, even in 2023, but not really now. And I'll leave it there because I feel like whatever, I've made the point that I want to make. But yeah, there was a remarkable turnaround that happened thanks to both administrations, the Trump and the Biden administration. People can critique, okay, did their policies add too much to the debt? Should we worry about the debt? How much of the inflation was Biden's fault? How much of the supply chains and on? We can talk about it if you want to. But like, fundamentally, if you're just going to isolate one variable, it is very good that we had two presidents that like both really immediately wanted to get the labor market back to some form of not just health, but vigor. That did have positives too. But yeah, the Fed indirectly making 2.7% mortgages available. So that helps them pulse that too.
So I think you're right. And I want to change my view. When I said, oh, it was only just rich people who got mortgages in 2020 and 2021 at low stimulative rates, you're right to correct me that no, it actually was a broader swath of the population. So I will continue and I will say the fact that Apple is now making money on its cash and that the wealthy are making money on their cash because interest rates are no longer at 0%, they're at 5.3%. I still stick to the view that is not very stimulative and that the credit effects of higher interest rates in terms of there are fewer loans being made because the cost of credit is higher. That contractionary effect is greater than the what I perceive as mild stimulatory effect of higher interest rates, and therefore that high interest rates, as traditional economic theory, as the Orthodox and the Federal Reserve believes, are cause the economy to slow down. Now, maybe they don't. So far, they haven't caused the economy to slow down as much as people thought. I don't even think the Federal Reserve thought we'd go from 0 to 5.3% when they did their first hike in 2022. But yeah, I think, as you say, you're right. The U.S. economy is 70% of the consumer, and that's the labor market and their household balances. There's a huge influx of cash into bank accounts in 2020, both from the government and then later on from the strong labor market. The first force, I don't believe, is with us any longer. And the second force, according to your reporting and according to the unemployment rates, which I believe bottomed at 3.4%, is now at the still low but much higher level of 4.3%.
I'll say for anybody who's listening, before I stepped into my current role, I was a staff editor at the Times, and one of the people that I edited was the brilliant Claudia Sahm. Obviously, she is the most famous economist in the country, at least in macro circles now. If you didn't know her, you definitely know her now. And yeah, her rule has been triggered.
And remind our audience today of the
yeah, so it's a bit complicated. Like the intuition of it is very straightforward. It's when unemployment, as you said earlier, when unemployment tends to head up after it reached the bottom, after a certain point, it doesn't just hang around after being somewhat higher. It tends to lurch higher as consumer confidence gets lost, business confidence gets lost, and that's when people fall back in spending, which then causes further loss in business confidence, and the sort of natural snowball effect. Technically speaking, and I'm sure I'm going to butcher this, right? It's usually almost have to rehearse it. It's like if the 3-month moving average of the unemployment rate 12 months prior is now 0.5% above that low on a year-over-year basis, comparing the 3-month moving average where you are now to where you were before, if that exceeds 0.5 for half a percentage point, you are in the early innings of a recession. She built it. She was building it for a while. She's a former Fed economist. Now she works in the private sector. If you look at the reason she built it for fiscal policymakers, with the hope that you could pretty quickly get automatic stabilizers in the form of a democratically selected version of stimmy checks, essentially.
Automatic stabilizers is, for example, unemployment benefits. When people lose their job and they file for unemployment, automatically that happens. It's not like Congress has to meet in the chamber and say, send money to these people. The
idea is that you could, of course, there'd be democratic horse trading, but small t democratic horse trading between our elected officials. But the idea is that you could come up with some reasonable automatic stabilizer on top of unemployment insurance and things like that. So that could form a countercyclical policy that even if you are in the early innings of a recession, you yank yourself back out. Claudia had spoken to me for the Times for an article. She's spoken to plenty of others. She's spoken for herself and the pages of, I believe, Bloomberg. And so I would encourage anybody to go to her first and foremost to get a take on this. But my own take is that despite her incredible humility in this moment, where she says, look, there are a lot of indicators, the yield curve inversion indicator, this, that, and other. There's a lot of recession indicators that have had false positives, it seems, this cycle. Who am I to think that the weirdness of the pandemic, both going into it and the chaos coming out of it, wouldn't break, quote unquote, my rule either? I think that's perfectly fine of a take to have, especially as somebody that the creator of this empirical pattern rule. But I think the Sahm rule, even as originally created, was meant to destroy itself. And I think the optimistic take right now is that when you think about what were people, Cam Kotok calling a bull getting 2.0 or something like that.
The sell-off on Monday, probably it was exactly 2 weeks ago.
Yes. Oh, sorry. Yeah, I'm giving no reference points to this. Yeah, so the massive sell-off that then by the end of the week had reversed itself. The VIX was spiking, the Treasury yields were plunging, and flight to safety, right? I mean, it was a crazy day.
And yeah, just context, that happened the Friday before week job market report.
Yes.
And that's
where the Sahm rule was triggered.
Where the Sahm rule was triggered, and that's caused Treasury markets yields to fall. And maybe there was some dovish verbiage from the Federal Reserve, to be honest, I don't recall. And then when lower Treasury yields, that strengthens the yen, and then so the thinking has gone, people who have piled into shorting the yen at zero interest rates to go long the dollar to earn 5.3%, or the Mexican peso to earn even higher. That has been a very profitable trade as the yen has collapsed in value. The yen strengthened and went from 1 to 145, somewhere around there. And the Nikkei sold off and the stock market sold off. The VIX briefly, pre-market went to 65. Some people think that's a somewhat false reading, but that's neither here nor there. Anyway, that's why the Sahm rule matters.
Yeah, and a big slice, I think, of why you had that market sell off. How big was the slice? Who knows? Really intelligent people and deeply invested people managing money for either themselves or clients or institutions can fairly disagree. Clearly, the weak jobs market report that triggered the Sahm rule was a part of it. Ultimately, back to the point of the Sahm rule could plant the seeds of its own destruction in a positive way, is if everybody starts freaking out because this very reliable recession indicator in a backward-looking fashion says, hey, code red, boys, let's heads on a pivot. It's time to start seriously thinking about whether the labor market will break. And if she's right, and essentially what happens is for a long time, in Q1, people were talking about, man, not only should we maybe hold at 5.3, might we need to raise rates?
I always thought that was dumb. I didn't say it because I, objective, blah, 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 but I always thought that was dumb.
Well, also no comment, but we're not there anymore. And if the ultimate result of everyone freaking out because of the Sahm rule, maybe freaking out a bit too much, right? I think even Claudia would say that some people were freaking out a bit too much. But if the ultimate result is the Fed pivoting and they get it right, they soft landed. And if the Sahm rule ends up playing some part in that, I don't think that the Sahm rule will have failed by triggering code red. You could argue that the Sahm rule may in the end have played an important part in signaling, hey, the risks are balanced. In fact, you might be out of balance. Time to head the other way.
I think when the Federal Reserve says the risks are balanced, I think, number one, they could think the risks are actually balanced, but it's their way of saying the risks are no longer to the upside. I think now the risks are to the downside.
Yeah. So I'm going to flip it back on you. Like, where are you on this? We had a conversation with market participant and an economist type last night. We're in the camp of, hindsight's 2020. You could look back and point to the 2023 summer environment and say that they should have taken the W then, mission accomplished. If you take out OER, which is a price that nobody actually pays, you're fine. You're literally fine. Stick with it. Basically, what we had last year was last summer, a 2019-esque Goldilocks economy. If you contort the price data a certain way, take the W and go home. Work on your golf game, as David Kelly at JP Morgan said. They decided not to because they were still worried about the other side of their mandate, some people would think that what should be the main part of their mandate of price stability. And I think there are a lot of people, including the gentleman that we were talking with last night, that said, they were right to do that. And look, if the pain turns out to have been unemployment's 1% higher than it would have been otherwise, to be more safe than sorry, then I totally understand the argument for this was worth it. Especially considering that in 2020, you had people, including folks that have been connected to Democratic Party, so it's not a partisan bias thing. You had economists connected to the Democratic Party that have served Democratic White Houses saying it seems like we might need 6 or 7% unemployment for a sustained period of years, and a double digit. We're all right.
We almost had a hard landing there.
Almost had a hard landing.
Not actually.
It wasn't my fault. I'm the best driver in America.
You are a good driver.
Yeah. When you have those folks saying that, their base case is essentially, I don't know how we're going to get rid of this inflation problem unless there is that sort of pain. And it turns out, okay.
Might you be referring to someone who would call into a Bloomberg interview from his estate, his residency in Bahamas?
I am not only talking about that fella who, I had a long conversation with in August of 22. He wasn't alone.
No.
I think this is super important. Like in the same way that, correct me if I'm wrong, but like everybody from Goldman to whatever other major shops, we're on the transitory inflationary bandwagon. But again, I want to turn this back on you. What do you think? Do you think that the gentleman that we were talking with last night was right? And that, look, at the end of the day,
I asked Nick Timmeros, I think, about the most recent Fed meeting. I said, do you think it was a dovish meeting, a hawkish meeting? And he said, something to the effect that he's not really interested in his own opinion and that it's not really his place to express opinion. Tal, I think you have some fascinating macro opinions, only some of which to a less major degree our audience will hear today. And those are for two reasons. Number one, you want to be an objective. I think the three reasons. Number one, you want to be an objective journalist.
I want to be independent, nonpartisan, and do my job without fear or favor.
Fear or favor, yes. And number two, you have genuine humility that what the fuck do I know? All these economists with PhDs and who are so smart, they've been extremely wrong. So I'm going to be extremely wrong. What do I think matters? And then number three is that you work for an extremely well-credentialed global publication that brings other challenges. I have the first two issues, don't have the latter, but I think economic forecasting is really tough, and I really am just going to pass on that. I think one of the worst ways to opine on markets and on the Fed, and an even worse way to trade, is to say, this is what I think the Fed should do. Number one, you could be wrong. Right. Number two, it doesn't matter because you're not in that chair.
Right.
Number three, the people in that chair are focusing on their own thing and they don't really care what you think. And number four, if you focus and prioritize and privilege what you are focused on, and then the Fed makes a mistake, if you actually trade, you're gonna lose money. You're gonna be long SOFR December, and you should have been short SOFR December. And then you said, oh, I actually was right, but just the Fed made a mistake. And I think that is the lowest of the low type of analysis.
Yeah.
And I try and not have it on this program.
Okay. So I'll let you bail on that.
Yeah.
Here's one thing that I feel comfortable having a take on.
Yeah.
Which may surprise you. People said on this program for a long time, something is going to break. Rates were very low, then rates went very high. A lot of people said that is not going to happen without something breaking. Turns out something did break. The SVB crisis, sure, it could have been something else. Yes, to some extent it was tech guys in California tweeting in all caps in panic, and they're all in the same group chats, right? But like clearly something was breaking. You had the Treasury messaging how they're going to try to fix the problem in one manner. The Fed was messaging in a different manner. There's open questions about whether they indirectly maybe made universal deposit insurance the rule of the land. At least temporarily, to just calm everybody down, even though they didn't technically actually change the law. It was a crazy time.
Yeah.
Things were breaking. Folks I was on the phone with and people in government that I was on the phone with were both saying, we are very scared of what's going to happen on Monday in markets if we do not figure out how to stem the bleeding. Not just the regional banks, but all the banks outside of essentially JP Morgan, Bank of America, you name it, the city, the big ones. Yeah. We're really worried about what's going to happen, and we're not sure what the knock-on effects in terms of the actual employment market, the labor market, like where that's going to end. And they stitched it up. You can complain that how they stitched it up was not necessarily democratic, but like if you had a thesis of in late 2022 that something's going to break, and I'm super bullish on bonds, for example, because we're going to head into recession. It's going to be a more significant downturn than people think. It's not going to be immaculate disinflation. It's going to be a really ugly disinflation.
As Powell said, there will be pain.
There will be pain.
2022, Jackson Hole.
Okay, based on everything I just said, if you are managing a fixed income portfolio, to have made that bet. Turns out the people in power who have the job of, it's my job to try to, as best as I can, make sure things don't break down, did their job in like the most simple, direct sense. And that really killed that trade, as far as I know. Maybe I'm wrong, but
yeah, and the trade worked horribly in 2022, and the trade worked very poorly in 2023. 2024 works better, being long duration. So that is saying the Fed will break something in 2022. A lot of people were
highly reasonable,
and the Fed even talked about pain. That is the most extreme for Federal Reserve. That's just like death metal.
Yeah, I think so. So to keep our bit going here about what forms good TV sound bites.
Yeah.
How are you going to say don't fight the Fed on the way up, but then argue fight the Fed on what I think will be the way down? That made sense. Yeah, they told you pain.
Yeah.
And they did not mean that crypto was going to blow up and
No.
unprofitable biotech would no longer be an attractive investment anymore and that CRE would run into trouble. I think we all,
Meant unemployment and the economy.
I think we all anticipated not just bear market.
And that has happened to a way smaller degree than most people and most economists certainly most people on CBC, Bloomberg, and Forward Guidance would have predicted.
And quoted in the New York Times.
Yes, in 2022.
Yeah.
I think the banking system, I shouldn't say the banking system, a few, not small, but not giant banks broke for the most mathematically obvious way possible. Like when you raise interest rates, bond values go down, and mechanically, it's just the way it works. So it wasn't, the cost of credit has increased, there are fewer loans, companies are laying people off. It wasn't all these indirect facts. It just was this bank, Silicon Valley Bank, and I've talked about this a lot on my show, had an extremely long duration book. Interestingly, and I've heard people who have forgotten more about economics than I've ever known. Interestingly, a lot of people don't know that banks don't really own that many U.S. Treasuries as a percentage of the securities. It's a lot of agency mortgage-backed securities, at least now. Mm-hmm. So their losses were mostly on those agency mortgage-backed securities, mm-hmm. which as interest rates go up, their duration increases, so their losses are heightened. And then also the VC bubble of 2020 and 2021, it's not an objective bubble, but I'm just throwing that word out there.
I think we could all say it was a bubble.
Yeah. Now the New York Times said that. So yeah, I know. I'll chill out. There we go. And so venture-backed companies on the margin are unprofitable companies, so they burn cash. The only way deposits flow into that bank is by raising money. And the IPO window stopped, VCs stopped raising tons of money, so the deposit levels went down. It was a pressure cooker, it was a disaster. And I say this as someone who I rang the warning bell about the duration sensitivities within the banking system more than a lot of media. And
take the victory lap.
Yeah, no, and I covered it in great detail. I'll take the victory lap, but I'll also say I think that issue has not been as big going forward. Like there haven't been more bank failures. I think things in the banking system have stabilized. So I'll say like maybe I was wrong. I covered the negative side too much, and maybe I didn't cover. Hey, these banks are trading at a cheap valuation because there's a crisis priced in that there's a chance it will materialize, and it didn't. And I think that the issue facing banks now is credit. As the economy is cooling,
mm-hmm.
we don't say slowdowns, we say cooling.
Right.
As we grow up, get more mature.
Right.
But not duration. So the duration sensitivity issue, which I've taken a hard look at, that is fine. So in other words, the First Republic Bank and Silicon Valley Bank, they cater to their wealthy. They did give lots of mortgages I'll give you a 2.7% mortgage. So I hope that I win you as a wealth management client to get the 50 basis points off your multi-million-dollar portfolio. Yeah, that business model did not work when the Federal Reserve raised interest rates from 0 to 5.3%. Right. So yeah, nothing systemic has broken. There's a handful of things have been broken. A few banks, which are not small, but the banking system has not broken. The economy, even though it could be in a recession now, is performed way better than almost anyone expected.
The lagging data and the highest frequency data are still signaling that we are not in a recession, but there are a lot of empirical patterns based on historical data and some somewhat concerning data in terms of the hiring intentions and the hiring rate that would suggest that there are reasons to be concerned. Totally. Let's see whether you're gonna bail out of this one. I think there's a little on heat on this.
I won't. I'll just say I won't. I'll answer it in whatever it is.
Okay.
I commit.
So there are a lot of theories about what was going on, what was influencing the longer end of the Treasury curve, right? Which a lot of our markets are priced against. There's a lot of back and forth in between really worthwhile people to engage with on what was influencing whether the 10-year would be above 4, whether it would go above 4 into 5 and then even higher, whether it was actually about to crash back down to 2. And actually, you guys don't realize it yet, but we're going back to ZERB, right? Theories were flying.
They always do.
They always do. At the risk of jinxing further expansion of this economic cycle, now that we're in some form of being around the corner of mission accomplished, right? I don't think...
On inflation.
On inflation, yeah. If the Fed is cutting rates, then that inherently is signaling some version of we did it. And at the same time, you've seen inflation expectations plummet back towards completely normal levels. And so was it just the fact that in terms of, again, to get to the direct question to you, are we looking at an environment where there was a lot of uncertainty about what was driving longer rates? And now it turns out there was a tug of war between are we going to a recession versus how sticky is inflation? And obviously if inflation is going to be sticky, you're probably going to demand a higher yield. And now people have a vague sense of where inflation is going to be over a 2, 5, 10-year horizon and so on. And so now like rates are chilling out. I shouldn't completely say chilling out because of course we have only get a 2.0, but like I'm seriously asking myself whether it was just uncertainty about where inflation is going to go the whole time. And if you're uncertain about inflation and you can make 5% on cash, like why make a duration bet anyway? Is it possible that it is that simple?
Because interest rates are going to continue to go down, so you should own things that make money as interest rates go down. That's the reason.
Yeah, that, and presumably if a 5% on the 10-year is the best you're going to get, and you get some capital appreciation because whatever bonds will go down to, whether it's 3%, 4%, 3.5%, whatever. Yeah, why not? Why not snag that 10-year at 5% late in fall last year for your wealth management client? Like that makes sense. And if the Fed rates had peaked, it seems like they have, and inflation was slowly but surely coming under control, then some of the more expansive theories about the driving rates, whether it's Treasury supply or really complicated arguments about term premium, not their shade, as the kids say. Is that even what the kids say anymore?
It's what like 40-year-olds say when they want to sound like they're 18.
Right,
It's what the kids said like probably 5 years ago. I don't know. You honestly probably know more than me.
Yeah, probably. So not to undermine any of those arguments, you don't want to put yourself in a situation where you're saying like, oh, I have a range of guests on and I think these people are full of it if they end up on the wrong side of what my intuition is. But
so
is intuition more or less in the direction of, oh, it was like some combo of what's going to be the peak rate from the Fed and like, is inflation under control? And that's 50% or more of what was driving rates versus the more expansive and complicated theories about what was driving rates from 2020.
So I'll start by saying some people may be calling it Volmageddon 2.0. I think
it literally could have only been the people we were talking to that night. And I could be misremembering.
Yeah.
It's kind of just fun to say.
Okay, Volmageddon 2.0. I think Volmageddon 1.0, like an ETF that had a huge amount of money in it, blew up. And yes, the VIX went to 65, but I think according to what I read, like this, actually, according to someone, now I can be like, according to a source, like the short vol trade is alive and well. So, it could be even riskier. Okay, wow. We're in close to Kittery, Maine. So we started this conversation in middle Maine, and then we went to southern Maine, and now we are on the border with New Hampshire. So things are going. When earlier I said, I always thought that was dumb about people talking about interest rate hikes, the rich people on my show who said that, they are incredibly smart traders, and that's just, I'm talking shit. We're driving on a literally 9-hour drive ride. I might put it.
And if you're not talking shit.
Yeah, exactly. You got to talk shit. I might say, I never found that argument very convincing. And even though the people who I heard it from on my show were very smart people. So I definitely have no problem with disagreeing with guests in the rare instances where I do give my opinion. And this will be that. I think when it comes to the banking system, like I see people on TV say things about the banking system that I know are wrong based on work that I've done. And I'm able to tell that, okay, there's a chance I might even have an edge here, and there's a chance that I can keep up with the big boys, big girls. When it comes to what's driving the bond market, I really don't have that confidence. I haven't done the work. It's my hunch, though. Supply does matter in the short term, and if you issue $100 billion worth of 10-year notes, the market will find a way. JP Morgan will buy them. Some private sector non-banks will buy them, aka rich people institutions. China will buy them. Japan will buy them. So there will be a clearing price. It could be at a higher yield, though. It could be 2 basis point higher, 5 basis points higher.
It's a little messy of an auction.
So I do think supply matters. For a second part of our conversation, I want to talk about MMT and who really prints money. And I think for the US dollar, like the people will buy the bonds, and there may be a day when that doesn't have an issue. But right now it's not, can we issue $100 billion of 10-year notes? That's not the issue. It's if we issue $100 billion of 10-year notes, will it drive the 10-year up from 4.3 to 4.5 or even to 5.5? And a dramatic example of that was the UK gilt crisis in September 2022. Mm-hmm. That's different. The UK sterling used to be the world's reserve currency. It's not anymore. Yeah. That's us. And I think that to take the world off of sterling and the gold standard, it took off the sterling standard, it took 2 world wars and a Great Depression. So do I think that whatever news that happens on Tuesday is going to cause the end of the dollar standard? No, I think it's going to take a lot more than that. So I'd say it's a mix of inflation and growth expectations. And
that's what you call talking shit. You're the most polite shit talking.
No, when I was talking shit, I was talking about saying that the view was dumb that the Fed would hike, which I just thought it was wrong, not dumb. But yeah, I think supply does matter. Like in the spectrum of people who say it's only supply and there's just not enough demand. And then there's this bias people say, actually, it doesn't matter at all. It's only growth and inflation expectations. I'd say I'm somewhere in the middle. And I think that it's just a fact that the private sector and foreign governments' ability to fund the U.S. government, by which I mean buy their bonds, we can leave it the question of, are they really funding the U.S. government to a later part of our conversation, is they can do it a lot easier at 1 month treasury bills or 3 month treasury bills. That's like nothing. That's basically the same as cash. So they're turning cash from one version of cash to another form of cash. Oh, I'm buying a $100 bill with 5 20s. It's nothing to them. But to buy a 30-year bond, that's a commitment. And it's liquid, but it's not as liquid as 3 month bills. So I'd say I'm somewhere in the middle. So Tal, now let's move on to the conversation we were having before this recording that was so good that I just got out my phone and started recording, which is a very loaded term, modern monetary theory. And I don't think it makes sense to start out by defining it or asking you to define it. People can look that up, but we're just talking about the plumbing of the financial system and whether the U.S. government spends money and then taxes and borrows, or as the traditional theory goes, they tax and borrow and then they spend. So that's why I said the thing about, does the foreign governments fund the U.S. government? Does the U.S. government really need to borrow money? Can't the U.S. government just print money? And I think a great way to put it, as one camper, Camp Kotok camper said, is that there is no financial constraints on governments other than the conditions that they face in terms of inflation and how they want the real constraints. In other words, like if your country is running out of oil and no one has a job, that is a real constraint. There's only so much steel and you want to build all these cars. You can't build the cars. That's a real constraint, but real resources. But to say there's not enough money, that's not really true because the governments can't face it. I think, Tal, and I, with confidence, like you are much more on the MMT train than I am. And there definitely are countries, and maybe even a majority of countries in number, not in wealth or size, but in number, that have to follow the rules of the old school economic orthodoxy, like Argentina, where
they're borrowing in other currencies.
Correct,
So
as well,
that's
because they can't borrow in their local currencies. So if demand for your currency is so bad that you have to borrow in other currencies, you are a monetary sovereign, you're in charge of your own currency, but no one wants your currency. So it's just a tough business. And inflation...
That does bring up a chicken and an egg thing,
yeah,
right? Because it's, okay, was your currency was your currency slash the bonds that your government sells, were those considered uninvestable beforehand or just in a sort of form of natural state? Or did something happen in your country like a coup or unfair regulations or something like that, which made it uninvestable? I have no Argentina expert. I don't want to mouth off as if I'm a domestic correspondent covering economics in Argentina here. I'm not. Well, and then I don't want to randomly drag us into let's talk about Argentina for half an hour.
Yeah, no, we're
like,
the theoretical model of a country that the demand for its own currency, including by its own domestic citizens, is so weak that the currency depreciates just day after day, and that when the currency depreciates, goods which are denominated in other currencies are so expensive and it inevitably causes inflation. So I think there are a lot of countries that if they followed the MMT playbook, it would be a disaster. And they have been following the MMT playbook for 50 years and it has been a disaster. And like the IMF, maybe it's unfair that they have to follow the IMF rules, but in our current system, a lot of countries can't have debt to GDP of over 100%. And emerging markets, and this is in a fireside chat with exclusive sponsor Van Eck about their emerging market funds. Emerging market countries have delevered enormously. So there was the tequila crisis of the 1980s. There was a lot of emerging market crises in the late 1990s in Asia of dollar-based funding flooding in and then the money flooding out, and there being a run on the economy and the financial markets and the currency at the same time, which is a disaster. A lot of emerging market countries have significantly less levered on a sovereign scale than the developed market economies. The U.S. government has way higher debt to GDP now than to the 1980s, but for a lot of emerging markets, they're actually less levered now relative to the 1980s. So the folks who I was speaking to who manage the Van Eck Emerging Market Bond Fund say that's one compelling reason. But I think the U.S. and maybe some other countries, maybe it is just the U.S., don't really have to play by the rules. And I think that is unfair. But I just look at all these people who say, let's say there's a 6-year-old guy who says, we're running out of money. The U.S. government is borrowing and interest rates are going to spike. because the U.S. is going to have a fiscal crisis and no one's going to buy the bonds. It's, dude, your entire life, the debt has just exploded higher and interest rates have gone down. So what is your entire life?
Well, also, like, what is debt? So I think all of what you said there is really valid. I actually wouldn't take that strong of a position on much of it because it's not my bag. I would reframe my quote unquote being on the MMT train into, I think a lot of what reporting is, all jokes aside about the nature of objectivity. Shout out to my pal Joe Weisenthal and that, who also cracks a lot of jokes about that. We're just neutral journalists calling balls and strikes like umpires. Of course, we're all humans. We all have our takes, but the job of a newsroom driven journalist to really wake up every day and just try to find out what the hell is going on for who you're writing for. Some people write for investors, some people write for other nerds in their nerd world, some people write for the general public, some people write for their very specific subscriber base.
And you are in the nerd world, as people have heard over the past 90 minutes, but you do write for a general audience.
I'll take it. And so newsroom-driven journalists try to do, right? The platonic ideal is it's not your job to give your opinion, even though of course we all have them. It's your job to really try and find out what's going on and give people information, whether in a narrative or feature form or just in a straight news data-driven form. And then, like in anything, very reasonable people that are either in on the action or that are former experts that used to be in on the action, or scholars or business people or the workers experiencing those conditions. It's like everybody has their viewpoint and you just try to weight all of those viewpoints as fairly as you can. I think American journalism for a long time either had no idea what I call, and there's a lot of disagreement across the economics world about what exactly is post-Keynesianism and what falls under its umbrella. But I think there was a lot of dismissiveness of MMT, institutional economics, other schools of thoughts that are either under that or within that. All that, to me, again, other people have different definitions, is related to this strains of thought of post-Keynesianism, or just more broadly, and in plain English, how do you manage a currency in a big country in a modern post-gold standard fiat world? I think I'm fair to those folks. I think some of the things they say sound awfully scary, even if I'm very friendly with incredibly smart people in that world. The idea that bond issuance is just irrelevant or wholly unnecessary, that's a big claim.
The scariest idea is that you work so hard and you pay taxes. Let's say you pay 15% of your income, 20%, 30%, 40% of your income. It goes to the government. And the idea that money is not going to fund public works, or isn't needed to fund the government, the police, infrastructure, the roads, the bridges, but that it's needed only to play some kind of shell game so that inflation doesn't get out of control. That is an idea that's highly unsettling to me, and I imagine unsettling to other people.
Is that infuriating or is that freeing? Right? That's actually an interesting conversation. Because on the one hand, if Social Security is really like money that your parent or my parent put into a piggy bank, and then they hit retirement age and they say, I put the money in the piggy bank. Can I get my piggy bank money back? That's satisfying in a way, but it's also limiting because there is no shell game. It isn't really just a game, or not, I shouldn't say a game, a social contract of IOUs. No, it's really all you have is this piggy bank, maybe with interest on it, right? Because CPI is what we use to adjust for Social Security payments once you are getting them. If instead, like one veteran camper explained to me, and I want to give that credit, this isn't my analogy, it's not a piggy bank. Social Security, it's much more like a membership card, where it's just like you're paying dues. In some general sense, as it goes, you're paying for stuff, yes, but also it's a loyalty card. You're a part of this crew, and after years and years of being part of this crew, there's a big benefit at the end, and we reverse it. Our dues are going to you. Are those things still related? Is it the perfect analogy? No, but the analogy is as best as we can. But it's like, that is fundamentally different. This stuff is actually hard. Like Rogoff and his co-author got in a lot of trouble because a really smart young economist absolutely roasted them on some mistakes they made about a paper about debt.
Yeah, so I'll break it down. It is saying how much the government owes relative to how much the entire country produces and consumes in GDP. Once it reaches a problematic level, it has negative impacts on
growth, demand for the currency,
and demand for the currency.
Maybe something else.
And
But
I don't know
those
the
are
exact levels, but I think at the time of the paper, let's just say that debt to GDP was 80%. And let's just say that the paper said the problematic level was 95% or 100%. We're now at 125% or maybe even higher for US government debt, and demand for the dollar is high. And growth does not appear to have suffered. Growth has been higher over the past 10 years than it was from 2000 to 2000. Part of that is because we had 2 recessions. But yeah, that paper is wrong. And then,
or there were aspects of it that Thomas Herndon, to shout out the exact guy that did it, as a young economist, he pointed them out. And so that sort of digression was a way of saying, and Rogoff and his co-author, whose name I'm forgetting, Reinhardt, yes, cover the world down. We're talking about Harvard people, Ivy League people, with the best schools, the best education, the best resources. And they're in active conversation and then debates with people about exactly how this stuff works. We just had a back and forth, which is probably too in the weeds. And / I probably shouldn't share my private takes on it, but the very nature of the
and you're driving.
Yeah, and I'm driving.
Tal has been driving for this entire conversation.
The very nature of the TGA, the Treasury General Account, right? This stuff goes far. All I know, and that I feel comfortable reporting as what I see it as a truth, is that inflation is the primary constraint on government spending for a currency issuer. And funnily enough, I feel like a lot of the conversations I've been having, increasingly, I've been having conversations with folks that felt differently in 2022 that now are warming up to the idea, oh yeah, okay, inflation expectations they were crashing, now they're not crashing, but they're settling. And there's some people that have argued that they're actually never that out of control, but they're firmly in control now. And I think what the Fed might call anchored. And yet, hold on a second, structural budget deficits are still expected to really grow over that same time period. So while, yes, especially on the sort of plumbing level of was this a good or a bad Treasury auction for a 7 or a 10 year or 30, yes, obviously supply matters. But I've had a lot of conversations with folks that have warmed up to driven or related ideas about, oh yeah, then if that's the current state of play, if inflation expectations are anchored and these budget deficits are still projected to grow, then they're maybe I should be rethinking whether there's this very tight 1-to-1 A to B relationship between debt and inflation. And I think people are right to be rethinking that. And whether, to go back to your original thing about, oh man, are my federal tax dollars going to a granny in Indiana and to whatever the things that I'm benefiting from the government, or is it just taking that money out of the economy and the primary good of government is inflation? Then it's weird. It's that is infuriating because nobody likes paying federal income taxes. But on the flip side, considering the structural challenges we're facing as a country, as a society, as a globe, it could also be freeing, right? It could be both things at the same time. And I think it's a legit conversation to have. And to the extent I've played a role in establishing the equal playing field for those ideas versus the sort of reactionary, or I would say reactionary fear of, let's say, the early 2010. I'm proud. I'm proud of that, and I'm happy to always defend them.
I think you're on the leading edge of that, and I would say, not to name names, but to name names, like people like Paul Ryan, who in 2011 were saying, we have to cut Social Security to our elderly people because there's just too much goddamn debt. And now we are 13 years later, and the debt is way higher, and both Democrats and Republicans agree that Social Security shouldn't be cut. I think Republicans have made the correct and politically judicious decision that a lot of their voting base get those Social Security checks, and that it's just not going to work. And look, there is no debt crisis. And now Paul Ryan is talking about how he likes stablecoins because they can buy more debt, which in stablecoins are, the fact of the matter is banks already serve that function. And by the way, I think stablecoins actually could be an interesting use case for the blockchain technology. That's neither here nor there. But there are two things. Number one is that the two claims that we have so far talked about. One is that the constraint on government finances is not how much money they can borrow, but how inflationary the consequences of their spending is, because they can just print the money instead of borrowing. Number two is what you just said, is that the connection between fiscal spending and fiscal deficits, i.e. printing money or borrowing money, and inflation isn't that big. If you put two of those,
I wouldn't say it's that big. I would say it's Mackie. It's not A to B.
Yeah, it's not A to B. You put two of those things together, and I think you get a claim that some people might view as dangerous, because if both of those things are true and you run a government based on that, you just print as much money as possible. And, oh, you want to build some projects? Here's the money.
Yeah.
And I think there's a reason why people have traditionally resisted that.
Well, there's always a danger of debasing the currency. And
Yeah.
somebody says,
And how do you find debasing the currency?
if the purchasing power of the currency is devaluing, not in the desirable way where you have relatively low stable inflation, repeatedly having wild zigs and zags somewhere in between high single digit and high double digit inflation, yeah, that's a debasing of the currency. I mean, I know for example, hyperinflation, going back to things that happened in the interwar period or during World War, that's an extreme version of it, but we cannot say that this is not a problem or a concern, because there are people's, maybe not grandparents, but certainly great grandparents that have lived through hyperinflations, through currencies becoming debased, through purchasing power being so destabilizing. People didn't really trust each other to make nominal contracts. Folks that issued debt with interest weren't interested in that because the value of what they get back would be so much lesser. That's a very real concern. But that's part of there's part of the argument about sovereign bond issuance that is strictly about the plummet, the interplay between and how that's connected to democratic, again, small d, democratic directives from Congress, the Fed's role as the government's fiscal agent. And then there's just, it's nowhere near as loose as vibes, but there's the theoretical and just functional role of bonds, which is people have a currency. They do just about whatever they want with it in a free society. Invest it, save it, spend it. You have excess dollars left over. And why not exchange those dollars for interest-bearing dollars if you truly believe that giving your money to the government and the government giving you back that money with some interest is a risk-free asset, which to this day, even incredibly worried folks on this issue, I guess you could like deficit hawks that are also actively managing money in finance, they'll still, in their research notes and talks with clients and TV hits, they still frame this asset class as wherever treasuries are trading as the risk-free rate. And that's no coincidence. And that's an important thing not to skip over. Now, is there zero risk? No, and Ernie Tedeschi has done some recent work on this, how essentially the brinksmanship that we bump into every time the debt ceilings, that means that actually there is some risk, but that's a political decision, and political decisions are real. Tiers would argue that political will is like a big part of what is and isn't possible just on a baseline level. But I think it's really important for everybody that is, broadly speaking, in our world to really wrestle with what the depth of what that means when we talk about risk-free assets. And yeah, I personally feel like that was a big aha moment for me, because it essentially just checks out on a baseline level logic that, yeah, especially if you expect there to be some inflation or some elevated inflation, then a smart maneuver might be, well, I'm going to check out where I think inflation will be over this time horizon, and then hopefully buy a bond that is risk-free from a government I really trust, and have that rate, buy the asset at, come in at a higher level than inflation, and you hope it works out. And that's actually a really sensible way for governments to build trust in their IOUs.
But if inflation is so high and interest rates are below that, people are screwed. And actually, that's one way to delever and decrease the debt, is just to have inflation higher than that interest. Debt growth is growing, but the economy in nominal terms is growing higher.
I don't think there's that many people of consequence. And I guess I could say no offense, but that inherently sounds rough. I guess it is a little bit of a burn.
Yeah. No one of consequence thinks what?
No, nobody of consequence thinks that the ideal way to quote unquote rid yourself of a debt burden would be to just inflate away the debt. I think a lot of folks think that while there are very few solutions that are silver bullets, if you think there needs to be a solution in the first place, there is a camp of people that think that we don't need to be seeing this as a problem necessarily anyway. But if you think it's a problem, I don't think many people get taken seriously that think, oh yeah, let's inflate away the debt.
But
right?
the only other way is to run a budget surplus, and that doesn't seem realistic at all. Like let's say inflation was super high.
Is that the only other way?
I don't know. If you tell me another way, I'll believe you. But
the economy can grow.
Yeah,
you can have a large share of debt issuance going to folks that don't have a massive propensity to spend.
I think we're saying that you can have the economy grow faster than debt growth. And debt growth is just that year's budget deficit relative to the total stock of debt. However, if interest rates are sufficiently high, it is very hard. Like if inflation goes to 20% and they have to raise interest rates to 22%, it is very hard to have nominal growth continue to beat that 22%. And as inflation comes down, it's even harder to do nominal growth. So I think, I mean, we did, as you know, the Federal Reserve did do yield curve control during and I believe after World War II to peg yields, and the debt to GDP, which I think peaked as higher as we are now, 140%. World War II was pretty expensive. It went back down. So I think that is possible. So I think
the economy is also ripping after World War II.
Yeah.
And there were other things that the government did. The government issued war bonds. We haven't really talked about taxes. You could also, if you think this is all like some crazy game that the government needed.
Run a budget surplus.
Or not even a budget surplus. Just if you think that it is really important for the gap between what the government has spent and outlays and how much it is taxed back to match up with Treasury issuance, bond issuance as a government, and you think that's really important, and you are worried about supply and you're worried about oversupply, then okay, one thing to do is maybe you don't have to run a budget surplus. Just take down on these terms. On those terms, just take down the amount of supply. How would you do that? You would just have a smaller deficit on a yearly basis again and again. And one way that we could do that is going back to Clinton tax rates. People don't like paying taxes, especially rich people, middle class people, upper middle class people. The Democratic Party is one of the two major parties we have in this country, and their base it's full of a lot of upper middle class people that don't like to pay taxes either.
People don't like paying taxes.
People don't like, and that's why they moved up to $400,000 in terms of,
if you make less than $40,000 a year, we're not going to raise your taxes.
And there's an entire other discourse about how truthful that is if you take into account this tax or that tax, that maybe it's a sideways way of actually having those people. But the point is, right, people don't like tax. So it's this interesting question where, while on one hand, it almost seems cruel looking back at some of those things that were proposed across the last few decades that have hit a fever pitch at different times, right? Including the early 2010s, debt panics. Yeah, like when it actually turns out that everything's okay, and then, wait a second, let me listen to you. You would have cut my grandma's social security check, and she ain't a rich woman. The fixed income that she has right now is tough for her, and you wanted to cut that down even further. It's super reasonable to think of that as not just unnecessary, but potentially cruel. But also, if you're in the camp of all this, what are you guys even talking about? Look, just tax and spend, and then figure out how much you want to tax and figure out how much you want to spend. And yeah, you could do some of this debt financing with this other. Yeah, I think that's a reasonable perspective. But we're at the point right now in America where this came up during the fireside chat that I was involved in of, look, if you take away non-interest, non-defense, non-mandatory spending, you are talking about a very small portion at large of the budget. And there are very few people I know that think it's a great idea right now for the United States to pull back in terms of the AI race, which is inherently connected to defense, and just traditional defense spending to be prepared for, but hopefully avoid war with China, Russia, whomever. And so if that's the case, I think, as I said, maybe with actually an expletive that night, and I won't use the expletive then, it's time to talk about what we're actually talking about. And I do not think that debt equals scary is a conversation that this nation is deserving of. There's a nursery rhyme macro version of things that, one, I think is a bit paternalistic, but yes, may sound simpler. But if the truth is more complicated, I think we should just be trying to tell the more complicated truth. I don't actually think it's helpful to uphold noble lies and the nursery rhyme stories because it could either threaten power or confuse people. I mean, I went on for a while there, so obviously you touched on something, but yeah, I have no idea what to make of it or how you would create a follow-up question for that.
Yeah, I think that maybe people's aversion to modern monetary theory or these ideas is that it can take you to a dangerous place. For example, if the government can print as much money as possible, why do we even need to tax Bill Gates? Why do we even need to tax rich people at all? Modern monetary theory, some people think of it as a left-wing philosophy, but left-wingers can use MMT, but it really is agnostic in that regard. You could say, I want to pass the biggest tax cut in human history. It's going to cause the deficit to explode, and I want to do it during a pro-cyclical expansion. But the reason I think it's going to be okay is because we don't have inflation, and inflation is within the Fed's mandate of 2%. That happened with the Trump tax cuts, and he's not exactly someone you call left winger.
Inflationary. I mean, that's the thing.
He causes. I'm not talking whether they were or whether not inflationary. Okay. I'm saying that the reason that Trump saw fit, what he said, and MMTers caught on to this was that the deficit doesn't matter. They said, the reporters said, well, Mr. President, what about you're going to cause the deficit to explode? He said, inflation is under control, and therefore it is appropriate debt.
Yeah. That's great.
Yeah.
Yeah, sometimes I love Trump. Obviously, he's done things that seem extremely threatening in terms of the stability of our democracy. And there are a lot of reporters at the Times that, again, without fear or favor, I think do a great job. Others may disagree, but I think do a great job covering him and cover him on a day-to-day basis. I don't, so I think I missed that comment. But there's some insight there. Plenty of stuff to complain about. Plenty of interesting things for journalists to cover, for people to vote on. I'm not saying that the world of 2019 was perfect. I've spent a lot of time actually saying and reporting that things could have been better then, things would be better now. But I think we're actually earn a lot of credibility with many of my sources who, surprise, surprise, are, right-leaning finance people, as they realize I don't think there were certain things about Trump economic policy that were inherently wrong, and that I think Mr. Trump and Steve Mnuchin and others involved in that administration actually got things pretty right in some senses, and got pretty unlucky with pandemic.
Yes.
Of which we hadn't really seen since literally 100 years ago, around World War One. Does that answer some of your questions?
It does, and also I think it's important to say Trump didn't cause the unemployment rate to go from the low level it was in February 2020 to the incredibly high rate was in April 2020. And Biden did not directly cause inflation to go from below 2% to 9%. I think president's policies have important differences. Everyone is shaped by the environment they live in.
Yeah, the environment matters a lot. Just like what zip code you were born into matters a lot, which is, I think, something that you're getting at there. Also, if you're a president, what economy you step into in January, whatever year you assume office, like that matters too. And do I perfectly call balls and strikes? No, but I do my best. And I think we've had two really old guys that have gotten a lot of great luck in some senses during their presidencies, and also experienced like a lot of bad luck. I mean, if you're Trump, everybody says that not everybody. A lot of very important people say the world's going to fall apart if you're elected president. The world doesn't fall apart. Consumer sentiment's actually doing pretty well. The tax cuts do not lead to a debt crisis. You're starting a bunch of really nasty culture wars that I guess some of the base likes, but others don't. The tariff thing was also supposed to be somewhat disastrous, at least according to some really even experts. And were there suboptimal outcomes from some of the reading I've done? There were suboptimal outcomes, but it didn't cause a crisis. The Trump version of the Trump tariffs 1.0.
Yeah. And I'd say when Trump, my own opinion, obviously, what Trump says, if Kamala Harris gets elected, there's going to be a 1929 style crash and a depression, not a recession. Like, there's no way he could possibly know that. It could happen, but I don't think it's going to be because of Kamala.
He might be talking his book.
He just might be talking his book. And if Democrats say the same thing about the Trump presidency, they might just be talking their book too.
Yeah. And there was a conversation at camp about the rule of law. And I think the rule of law, getting back to some of the government finance stuff we were talking about, we should not underestimate the extent to the entire world trusting the U.S. rule of law, how much that factors into the extent to which that factors into our legal system, our global financial system, which is basically pegged to our economy and to our monetary system. So that none of this is to say that there aren't open questions about somebody that has had a lot of anti-democratic tendencies, against anti-democratic tendencies that person might do, shot at power. But I just spend my time, or at least most of my time, focused on how is this policy going to affect the business environment, household income and wealth, and, the outcomes of workers. And I feel like as long as that's my North Star, I'll have the respective sources across the board and, on my good days, write good stories.
Tal, so I asked you what currency depreciation means to you, and you said inflation. So there's inflation, and then there's also currency depreciation against other currencies, which makes purchasing things from other countries more expensive. So that's why Argentina has all this inflation, or had all this inflation, is because the currency is so weak. You referenced hyperinflation in Germany in the early 1920s, and they had a real resource constraint. Yes, the Reichsbank was pumping out and printing money. Interestingly, most of the money they printed was not bank reserves, such that the Federal Reserve doing quantitative easing, but literal cash printing, and that was going to buy goods on the open market. France at the time was occupying the Ruhr, so a lot of Germany's industrial capacity was being occupied by France. And also, the government just owed so much money because of reparations in other currencies. I think it even could have been gold that they owed, and they didn't have a lot of gold. So I think a lot of these things that the government needs to borrow money, and it can't print its way. Like in a gold standard, I think that's literally true. A camper, and again, to honor the Chatham House rules, I would say a camper, instead of saying the person's name, said that They thought that it didn't even apply in the gold standard, but he later said that was because they just went off the gold standard in a crisis. Of course, 2 years where the gold standard is causing a global depression, I'd say that those rules do apply. And Zimbabwe, interestingly, modern example of hyperinflation. Interestingly, Zambia, which I believe is a neighbor, is doing fine, according to the emerging market people I speak to. But yeah, it's about real resource constraints. So we've solved pretty much everything, right?
We haven't solved everything. I think in an interesting way, there's going to be a lot of talk about tax policy in 2025, no matter who's president, because of the TCJA, the Trump tax cuts, quote unquote, expiring. And the nature of that will likely tilt us away from inflation as the constraint, real resources are the constraint sort of conversation. One, because it's at least partially true, and two, because it, again, is that nursery rhyme, easy to tell story. Like, whether you support a higher tax of this set of corporations, that set of corporations, or on certain individuals and households or not, there's enough money on the table to where a lot of the conversation will be directed around, if taxes go up on this or that institution, or household will have more money for blank. But I also think at the same time, there'll likely be a conversation. I guess we'll see. You'll probably be covering it in your capacity. I'll be covering it in my capacity. Or people will be asking, let's say, especially if Trump gets in with Mr. Vance, and they say, let's just extend this whole bad boy. Let's do it. And also do some stuff on top of that, spending less taxation. There's conversations about if that's too much Treasury supply, whatever that means.
Yeah.
There'll be a lot of interesting conversations about, will those tax cuts, we're talking in the multiple trillions there, will those be inflationary? That's all we can hope for, is that normies, whatever that means, get a little bit closer to the open, honest, but complicated conversations we were having at camp, and the noble eyes and nursery rhyme stuff sort of fades into the background.
So the government needs to build something. They need to invest in a project that needs to be built.
Yeah.
Solar, you're going to bring manufacturing jobs to America. This stuff isn't free. You want to support home building America. This stuff costs money. It's going to increase the deficit unless you raise taxes. But inflation's low, so we can get away with it. Inflation's at 1%. It's not. It's at 2.9%, but it's at 1%, so you can get away with it. It's at 2%. We can get away with it. What if inflation is at 10% and the government, which according to an MMT framework should be running a surplus when inflation is high, right? That gets a little bit dicey. And it's not politically attractive to run a budget surplus because you have to raise taxes. Fiscal is what matters. When inflation's at 10%, should be taxing people. And if it is a demand-driven inflation.
Yeah, I think, my formal answer to that is yes, no, maybe. The makeup of the quote-unquote deficit matters just as much as its existence itself, right? Like, one of the things that I lean on in these conversations that helps me break people's brains a little bit, hopefully in an aha moment way and not in an infuriating way, as I'm sure I've infuriated some people. It's, hey, these sort of conversations that Jack and I are having sound scary or weird or unnecessary to you. Let's say that, I'll mention two things. The one I started with, and this was before there was ARPA, the American Rescue Plan, the Biden plan, and that passed by Congress in 2021. So even before that, I would say, okay, there's a lot of UBI talk in there. You're worried, oh wow, we're hitting traffic jam here. You're worried that BI would be inflationary because it'd be government spending, and especially if it's deficit finance. I agree with you. Let's say that a massive UBI, whatever, giving people $20,000, like all American households, $20,000 a month, and there's no rollout period. You just shoot it out to people, and yeah, $20,000 a month to all American households to be a lot. Let's say you quote unquote pay for it with some version of a wealth tax that is issued in a certain way to where it actually doesn't come across as a red flag to the Supreme Court. Probably a tough one to design.
Yeah,
but
you manage to extract money almost exclusively from very wealthy people.
Yeah.
Give it to all Americans.
Yeah. I would disagree a little bit with the way you frame that, because I'm a little less sure than others that functionally the way that money would get to people is because we took it from Elon Musk or Bill Gates or you name it. But yes, if the idea is we're going to quote unquote pay for $20,000 a month UBI, then yeah, that could be budget deficit neutral. I think every economist you and I talked to would say it would be highly inflationary.
Yes.
So
because the wealthy people, the mostly wealthy people for whom it will be taxed, have a much lower propensity to spend than the average American.
Yeah, I think that's true. But one of the things I've tried to be careful about is I do not think that different schools of thought that we've been talking about should lead you to think, oh, if we give middle class and working class people money, that's inherently inflationary. I think that could actually lead to a lot of not necessarily pro-social outcomes. And what I'm saying more specifically is that if in this crazy scenario where somehow, and look, maybe it doesn't need to be, I don't know how this works. It may be an estate tax, which is already totally legal according to the Supreme Court, I think. Like maybe that would pass muster, whatever. But the point is that a policy being budget deficit neutral does not guarantee that it will not be inflationary. And that's because you give those people $20,000 a month. But has the economy become $20,000 a month to every American household? Has it become that much more productive so that there's enough goods and services to go around?
Right, but you've drained the pond with the wealth tax. So why would every economist agree that taxing wealth, which is by definition largely held by the wealthy, to give the universal basic income of $20,000 to every American, why would that be inflationary? In a way that doesn't have to do with the propensity to spend argument, which you disagree with.
I don't fully disagree with that. I think just only having that, or even primarily having that as a main concern, can lead you to be very fearful of giving. And I shouldn't say giving, because it's public money. We elect our government. Our government's not just giving us things. We elect them to shape our world in a way that ideally there's corruption, there's inefficiencies, but ideally it's based on how democratically we decide we want to structure things. I think that the bigger issue, rather than just marginal propensity to spend, which yes, especially most working class people, also a lot of middle class people, they don't have enough saved so that if they do get a burst of money, oh man, I'm going to pay down credit card debt. And then there's this or that or the other thing that I've been hoping to do, but I've not had the resources to do it. You decide to do it often. But the question is, are the resources there for that? If, again, and this is, I don't want to insult like very thoughtful UBI people, but if you have this unthoughtful, drastic, sudden UBI, universal basic income injection, you could easily run into problems in that way. So I guess that's just how I would slightly.
So that doesn't matter, but it does. But it doesn't.
Yeah, I think that's the funny way to put it. But yeah, that's totally fair. Like it matters, but it doesn't. But it does in particular contexts, and that's true. The details do matter. There are fundamental truths, there are uncomfortable truths, and part of the job, part of being a human, is figuring out that context and making sense of those details. I'm inherently very suspicious of super simple stories. Whether it's like, why did we get inflation? I think we both would disagree with folks that say, it's because somebody's Uber and another guy's babysitter got stimmy checks in spring of 2021. I won't speak for you, but I know I've been frustrated by the idea that businesses that didn't take advantage of the opportunity to have particularly aggressive cost plus pricing. Supply chains were real. Also, consumer price sensitivity, insensitive, right? Like all of these things matter. The details matter. It's very hard to do unfalsifiable counterfactuals and stuff. Like there's some people that think we were actually going to go into a recession in 2020, even though the pandemic happened. How are we going to know? And how are we going to know whether inflation was transitory or not?
Or that
if Ukraine didn't happen.
The bounce back in economic activity that began in April, which even though it's still so bad, it is an expansion, that would be slow and the unemployment rate would stay at 14%.
Yeah, in a way, that's how the both of us make a living, is that the context does matter, the details do matter, and hopefully more and more people subscribe to the New York Times, more and more people subscribe to your work, and we just keep on having fun. But yeah, I think the complexity is really cool and interesting and important, and resisting simplicity is like a big part of trying to get it right.
Yeah, I agree with that. Do you have any questions for me?
Oh yeah, let's do like a random fun lightning round. Okay, what questions after?
Because I don't get to, normally if I'm talking to Sheila Bear, she rescued Wachovia. I can't be like, Sheila, do you have any questions for me?
Right.
But you're a journalist, so
yeah.
Fire away.
Here's one thing. How is there not going to be a breakdown in this very incestuous seeming private credit stuff that's bubbled up? Because on the one hand, I hear some folks talk about it, and it's like, look, at the end of the day, if it doesn't work out, it's not that systemic, and it'll be rich guys pissing other rich guys' legs, and they'll hire lawyers, they'll figure it out, there'll be some bankruptcies, but the rest of the actual economy will keep on chugging along. But I hear other folks say that's literally what everybody says. It'll be fine, it'll be isolated to just rich people with high risk tolerance, and then whoops, like we've given ourselves a newfangled crisis. So it's one of those things where I would classify myself as an economics journalist. You would probably classify yourself a bit more as a financial journalist. Yeah. So we're like, without biasing yourself on either of those narratives, like what smells right now in terms of the question of a private credit quote unquote bubble?
private credits are loans that are made outside of the banking system, and they're not made with leverage. They can be levered, but that leverage comes from the banking system. So rather than JP Morgan lending to a business and creating that loan from nothing, a private credit company, let's say Ares, which is the largest private credit company, named after the god of war, gets wealthy people and high net worth individuals, endowments, institutional investors, insurance companies to give money into a pool, a private credit fund, and then they lend that money to that business. The banking system is a lot more regulated than it was before the great financial crisis, and in many of those ways,
A lot more visible.
What do you mean more visible?
Basically, all those banks, or at least the ones that we think matter, publicly traded, the amount of visibility into their finances, the sort of loans they're making. My appreciation is that there's greater visibility, whereas that's why a lot of private equity and private credit, fairly unfairly, has got the shadow banking system.
So yeah, the banking system is regulated, and a lot of the banks, I'd say the vast majority of the big banks, are publicly traded. So you do get that transparency, and then with that regulation, I mentioned of Dodd-Frank, there's added stress tests, and it drives a lot of bankers crazy. Jamie Dimon, he thinks and has said that he's expressed consternation about, why do I have to raise more capital? Why do I have to book losses on this loan in advance when actually my people say that loan's probably going to be good? And I think probably if every banker was like Jamie Dimon, they wouldn't need those regulations, but they're not. And we know that.
People think he's pretty good at his job.
Yeah. So bank credit growth has been way lower, in part because credit is more expensive. Capital ratios are higher. Banks have to set aside more capital into the largest bank, a GSIB, globally systemically important bank, that basically you have to set aside extra capital, which means banking is more expensive. This has been bad for banks, probably good for financial stability, but bad for banks' ability to make a profit. And they've pulled back a little bit from making the riskier loans to businesses. This has created a wide open avenue for this private credit. It's a new way of financing things. Really, people were making private credit loans 5,000 years ago, just in gold or silver or whatever. They weren't raising money from Yale. But the modern banking system of just fractional reserve banking and of just making loans by making them from nothing, I think that originated in the 1300s in Italy. But the private credit way of just having money and loaning it to people, loaning money that already exists, and people think the banking system works by lending money that already exists. That's not how the banking system works, but that's how private credit works. So there's already a host of advantages that financial regulators who are invested in financial stability like this. Number one, it appears to have no leverage. Number two, it's wealthy investors, or Yale, institutional investors who can afford the losses, and they are supposed to be more sophisticated. And number three, so basically if it all goes bust, a couple of institutional investors got screwed, but it's not going to be a risk to financial stability. It's not Citibank is going to go down and all the other banks are lent money to Citibank, and so it's going to be dominoes falling on each other. And
it's a systemic crisis.
A systemic crisis.
So I mean, part of this is like, well, this is too good to be true.
Let me go through the things that are seemingly good about it. So it's not levered. It's wealthy people investing. It's not attached to the mainstream financial system, apparently. And they underwrite good credits, and they have a very good back test of performance. Oh, we performed so well. Look at how well we've performed. We've beat 8%, and the bond indexes have done 4%, or we've done 11%, blah, 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 blah. The reality is private credit assets were about 40 billion, so almost nothing in 2000, and now they're at 1.7 trillion. JP Morgan estimates that if you include leverage, they're actually over $3 trillion. So the growth has been enormous. And it's saying, it's like doing a back test on pickleball in 2000. It's not the same. It's gotten so much bigger now that you can't make it an analogy. Okay, so now I've said that the nice things about private credit. Now let's talk some trash. I think the performance has been really good, especially over the past 2 years as the economy has held up and credit losses have been low and credit spreads have been narrowing as nominal and risk-free interest rates has been rising as the Federal Reserve raises interest rates. So the pain suffered by the laundromat that has to pay higher interest rates, or by the private equity consortium that has done a roll-up laundromats and are borrowing money at floating interest rates, SOFR plus 400, that pain of the private equity of the laundromat is the gain of private credit. So that's why, and you probably watch more Bloomberg than I do. I love Bloomberg TV. They're phenomenal. And I see a lot of people from Ares, Apollo, Blackstone going on talking about the golden age of private credit. They're bragging about how well they've done and about how much money they have raised and will
Brag
continue.
so well, it's become a meme.
Yeah, the golden age of private credit. Imagine if you and I said, this is the golden age of podcasting, you and me right here. It's a little much, but the reality is the stock market was down in 2022. The bond market was down in 2022. Private equity, maybe the stated returns were up 3%, but the actual values were probably, if they were publicly marked the way the stock market is, they probably would be down too. I know Blackstone's like private equity returns over the past year, according to one prospectus, was very low single digits, so very close to zero, but their private credit book has performed really well. So also private credit will tell you, we do great underwriting. We've got the best people, and I'm sure they do hire smart people. They definitely pay them a lot. And so our underwriting is good, and we have covenants. Oh, we lend to the laundromat, and the laundromat operator has a debt to EBITDA ratio over so-and-so, or a loan to value. All these covenants of they got too levered that they can claw back things. Oh, we'll just take the laundromat. They have enhanced legal rights, and that underwriting and that covenant has been very lacking in the leveraged loan market over the past 10 years. And the loan market is basically the bank loan market that is now that replaced the high yield bond market as the venue of choice for financing private equity deals, which has now been replaced by private credit. So those underwriting thing, I think it used to be true, but the reality is it does use leverage. So that isn't really true. So it is connected to the banking system through leverage. It does, the covenants about our defaults are so low because we have these great covenants. I think that probably was true 2 years ago. Based on a few things that I'm hearing, the covenants are a lot looser now as private credit funds have sacrificed covenants in order to have a higher yield. And this is another thing that's important, is that the fees on private credit are high, and that's not in itself a bad thing. A hedge fund has high fees and they crush the market. The investors are very happy just to pay those fees, but they're so high that, let's say a private credit fund, let's say it makes the math even easier. Let's say so risk-free rate's at 5.3%, SOFR's at 5.3%. And let's just say they make loans at SOFR plus 670 basis points. So that's a 12% spread. And then it rallies to SOFR plus 470 basis points. So that's a 10% spread. The 10% isn't enough after the fees to really make that much money. So
it's not that sweet, actually.
Yeah, so they made money as the spreads narrowed, but with the fees so high, if they only invest in 10% loans, that's only a little bit higher than leveraged loans or high yield. High yield yields like definitely in the mid 8s, I think, or somewhere around there.
A little bit lower, but yeah.
Yeah.
In the ballpark.
Above 8. And if you're getting 10% and then you're paying all these high fees, what's the deal here, guys? So I think private credit has an incentive to go into the riskiest deals,
right,
which I think that increases the chances that this will end badly at some point. But to be honest, I think in the short term, it actually will be net stimulative because money is still flowing into this asset class. And that's another thing. Inflows, the money has flooded into this asset class as it's performed, and inflows make the performance look better. Because if you're a private credit firm and you lend to my struggling company, if, let's say, Sam Ryan's a Kotok camper, if he's able to raise a fund, whole lend to me, and that will bail you out of your loan. And then your performance will make it easier for some other investor to raise a fund at a higher value. So at a valuation, and inflows make default look low. This is what happened in the subprime crisis. Not that I'm comparing this at all to that, but when money floods into an asset classes, defaults are just lower because
it's a classic idea, right? So you know about Hyman Minsky, right? The cycles, right? But the tricky thing about stability is it breeds instability because the most risky people keep getting away with doing risky shit, and sometimes it works out. Sometimes, most of the time, it works out, but eventually you run out of luck. It happens. There's creative destruction, and yeah, there wasn't so much stability before, the risk would have built up so much. But yeah, eventually you get the instability, and then to your point, that I guess that is one of the. Is it like the big risk? I would agree that seems over the top, but yeah, it does. There are elements of it that seem too good to be true. But you talked a lot about credit spreads there, and so that brings up another question I wanted to put to you, which is, what do you think has just been you have to pick? No ability to hedge out of this. Sure. What has been the best macro markets indicator this cycle? I'll put my cards on the table. I think credit spreads is number 2, because in a way, bulls and doves all along the road. Sounded like they had it right if you were looking at credit spreads. They've been pretty tame, I think, even through periods of some pretty bad volatility. So that's number 2 for me. And then I'd say number 1, and it's a bit contrarian, jolts.
Okay.
Everybody hates jolts because the response rate is low or whatever. Yeah, sure. Yeah. Anyway, if you just followed not necessarily job openings, which is the top line piece of data that comes out of there, but the quits rate, the hiring rate, separations, layoffs, it's basically almost perfectly told. And I'm sure there's some month or quarter of data where actually maybe it didn't perfectly tell it, but as close to I think you could get, it perfectly narrated all the chaos of 2020, the resurgence in 2021. Some people the Great Resignation, which was, not the best term that all of us at Macro came up with because it sounds like a bad thing. But
It sounds like a chess term.
It sounds like a chess term. And
Yeah.
also it sounds like a bad thing, but it was like really great. It meant it's a wonderful time to quit your job and go do something cooler, better, more flexible while paying. But like it was all that, now the incredible cooling off of the economy. So not necessarily the economy, but the labor market. While layoffs have stayed low, the sort of nobody's really firing, nobody's really hiring dynamic that's going on. That I'm actually working on a story about. Not that I'll be the first person to bring that up. Jolts captured it, I think, very well.
Okay.
So I'm here to stand in defense of Jolts, just partly as a bit, but also because I actually think people need to put a little bit more respect on Jolts' name or names, job openings, layoff, and turnover. So I guess it's names. So that's my take. Where are you? And again, it doesn't have to be Jolts, it doesn't have to be credit spreads. It could be something I've not thought of.
I think when I first learned about like when people grow up, they have to do something, I freaked out. And when instead of figuring out what I wanted to do, I did a process of elimination. And I realized, okay, I can't be a doctor because it's just too gross for me. And then somehow I got to podcasting. So I'll do the same thing. And it's actually
That is the great.
easiest way to do it because there have been so many indicators that have led investors astray. So many things were signaling a recession in 2022. There was the inverted yield curve, so the bond market. There was weak consumer sentiment. There's the price of oil going higher. There was 2 consecutive negative quarters of real GDP.
Yeah, that got a lot of votes.
So let's just start with that. Definitely not that. I'd say the bond market people speak highly of the bond market's ability to predict a future recession. I wasn't really in the game when this bond market had the amazing performance of being the PhD economist, the smart money. Based on the time that I've been in the game, I give it very low marks. I look at the credit markets. I think like the credit spreads were very low and rallying into 2006. And so I think they are a lagging indicator. So I think this has just been a lesson in anyone who believes they think they have leading indicators. Like any stuff, it's just performed so badly over the past 2 years that it may perform well again. And it just was a 2-year blip because this cycle could be different. I think you saying Jolts is interesting. People often say that the labor market is a lagging indicator. Maybe it's
Jolts is lagging too.
Maybe it's less lagging this time, but the leading indicators that have performed so well, if you could take a time machine and you can go back 2 years, you even do well to just fade the message of most leading indicators. ISM, PMIs,
Yeah, it's not been useful.
leading economic indicators, inverted yield curve, all types of stuff. Nope. So I might say the stock market. The stock market has actually been quite a good indicator. We did have a mid-cycle slowdown in real growth as inflation was so high in 2022. I think a lot of large cap tech companies had hired so many people on their revenue growth just wasn't matching that growth in costs. So their profits went down. Now that's reversed. And I think there's also an aspect of as people continue to be employed, they pile money into their 401ks and that goes into the S&P 500. So I can't claim about any leading indicators, but I'd say maybe stock market is more of a coincidence indicator. I think you really have to take an educated guess based on your own analysis and like these back tests of the last 20 times this happened. So far, over the past 2 years, they have not performed well at all. That'd be a good way to do it from 2024 to 2054, but from 2020 to 2024, that was a bad way to play the game.
No, that's a good answer. Also, the method of just deducting things that don't work out and then ending up with whatever's the least dirty shirt. That's a smart way of just organizing intakes. Here's something completely in the other direction. This upcoming week, but I think next week, right after Labor Day, I'm going to be interviewing Khan. Why is everybody so mad at Leen?
So Leen Khan is the chair of the FTC. The incredibly important Federal Trade Commission. I only learned recently that she was not that much older than you, Tal, and that's incredibly important. Incredibly impressive how far she has come in a relatively short amount of time. And she's a thought leader in the space of stopping mergers and basically antitrust law. So if McDonald's wanted to buy Wendy's, she would probably oppose that and say it's anti-competitive and it gives corporations too much power. And I think the answer is
that would be my first question.
Yeah.
I was out of the blog. What do you think about McDonald's Wendy's merger? See what she says.
Yeah, I think that's a good opportunity because I've seen her interviewed both by Congress people as well as a show, not an economic show, but I'm not going to name it. And I think you're going to do better than both of them. So
It won't be live.
Yeah.
But it's for what will likely be a written article.
Well, I will read that, and our listeners here should stay tuned to that.
Yeah.
So I think, I can't offer you anything other than the obvious answer that I'm sure that Wall Street and big business, either incorrectly or correctly, think that if they can buy one of their, that not only will grow, but that will benefit their margins, because if you have a monopoly, it's pretty good. And that type of business of acquiring competition and rolling businesses up and consolidating the industry, it's been a pretty friendly regulatory environment over the last 30 to 40 years.
Yeah, under administrations of both parties.
Yes. And Leen is a hard liner in the opposite direction, and they think that this hurts them, and they're making arguments, which they probably do believe, about how this is bad for America, but I think they also believe that is bad for them and their companies.
Yeah, I think that's a fair summation. It's like a almost childish simplification of it.
But they are pretty mad at her.
But if I was just to describe the sentiment of certain people that I put on the phone with, that I've seen on TV, or the sort of quotes that you see in newsletters, like that. Yeah, you're like, how would you describe the mood? It'd just be anger. Anger. You always end up in dangerous territory when you immediately dismiss the concerns of business people, because oftentimes they know what they're talking about because they're doing the best to run a business or set of businesses. I can intellectually follow pretty well, at least I hope pretty well, the pushback of, look, you don't understand. The ability and or desire to be acquired is actually part of what makes capital markets and American capitalism work so well. And this is really well-intentioned stuff, this renewal of antitrust policy, but you don't understand. You're actually hamstringing American business and the American economy, right? I think that's a pretty fair channeling of the pushback.
I'll give one example. I'll just create a generic example of a business that creates aluminum cans. If there's only one business that creates aluminum cans and no other business produces aluminum cans, they are the price setter, not the price taker, and they can have monopoly level profits, and that's not good for the consumer. There are companies like Amazon, which they don't have a monopoly, but they have a dominant position in online retail. And I believe tell you, and I'm not being humble, like, you really do know more about this than I do, but I think one argument that has led the day is that even if Amazon had the oligarchical pricing power,
That's a tongue
but if it doesn't use it, it actually is cheaper than the mom and pop store, and it gives the savings and gives its market power back to the consumers, then that's not an issue. I believe Leen disagrees with that. One thing, really the only area where I deserve to have an opinion in this is, I think in the big banks, in the banking sector, like, there's been a tremendous amount of banking consolidation over the past 40 years, but it's still the fact that there are so many banks. We've been driving all throughout New England over the course of this podcast interview. We've probably driven past savings banks and regional banks and very small banks. There are thousands of banks in this country. In Canada,
very small, very tiny.
Yeah, in Canada there are only a handful, and I'm not sure that Canada doesn't have a free market like America. In the same way that it is, unlike a lot of the rest of the developed world, in its healthcare policy and also in its mortgage policy, in its banking policy, like, we're a country we originated in free banking, and basically the Wild West, literally the Wild West, and just having a bunch of very tiny small banks. Mm-hmm. I don't know if that's necessarily, a tiny small bank can't be as competitive because it doesn't have the scale as Bank of America or JP Morgan. I'd be curious to...
So since you're saying, like, it's fair to question whether necessarily big is bad. And I think the biggest critique of the Leen school of thought is that it essentially boils down to a hyper intellectualized version of big is bad.
Yeah, and it also, Apple, has, I would say, an effective monopoly in the high quality, expensive smartphone market. What do they really do? I understand the competitive stuff, anti-competitive stuff they do to other people, like they charge in their quote unquote services revenue, they just charge an arm and a leg for something. But what have they done to crush other smartphone competitors other than having a good phone that people want to buy. It literally is just the blue text. People want the blue iMessage thing. And is that illegal? Like, I don't know. But I mean, I agree with
I guess we'll find out, right? That's the awesome thing about the law. You're like, is this legal? Is this illegal? And some court says we declare illegal, and then usually another court says, well, hold on, we're gonna hear this appeal, and then sometimes it gets reversed. The law being a living, breathing thing is one of the most frustrating but awesome things about America. But yeah,
and monopolies are not. Oh, I say they're very often bad. They're not always bad. You don't want to have in a small town like 50 different utility companies because they're all competing with each other, and it's expensive.
Part of the reason we have utilities
to have clean water.
It's the part of the reason we have utilities in this country and other countries. But part of the reason we have them is because we decided, look, actually, fine. It'll be easier to deal with this, even if said company, whatever, the water utility company is a monopoly. But because it's going to be a monopoly, we're sure as hell going to regulate it in a way where they're not going to be able to operate like certain for-profit corporations, because we've decided we don't want the profit maximization function to be on full tilt for the water company because water is important, not Nike's. Now, but there is presumably a limiting principle in terms of like at which point for which sorts of businesses is that no longer a good model. Now, I'm not saying I don't mean to imply that Connor team like says that we should make Apple into a utility. As I understand the case, that is the antitrust case against Apple. That's not what's going on there. But I think we are swimming around some of these more questions of principle about what are we really talking about when we talk about antitrust? And what are the goals of this stuff?
Yeah, and the ultimate example of a virtuous monopoly is a currency. Like back in the day, every single bank, these 5,000 banks, they're probably more back in the 1800s, they all had their own currency, their own different paper bills that were backed by gold, theoretically, but it was just a total disaster. If you were in Florida and you were up in Maine, Maine wouldn't accept your Bank of Florida note or your Bank of Tallahassee or Tallahassee General Bank, whatever. Those banks probably all existed, but they would have 70 cents on the dollar. So it's just an incredibly efficient way to have a monopoly of currency, that being the US dollar, and then banks can issue bank deposits, which are all the same, but
because they are federally chartered.
Right, and the letter of the land, the law of the land is that a bank deposit of $1 is equal to a $1 bill, and that is a good thing. Yeah, but that's an awesome interview with Leen and Con. I'm excited to check it out.
Last question, slightly related to what we were saying. When you hear about moats, moat equals good for people looking for opportunities, generally for stocks. If you're piling into a stock and you believe that company has a moat in their business, and I think most of your viewers, listeners, et cetera, whatever, will understand what moats are, but just
literally, my sponsor, Van Eck, a lot of the reads we've done has been for their moat ETF about high quality businesses.
That's actually funny.
Yeah.
I am not plugging Jack's sponsor. That's a complete coincidence.
No, you're not. I am.
Yeah. I don't know exactly what the strategy is of that ETF, but it's the principal general
pricing power.
Yeah, it's pricing power. So I'm taking too long to get to that point, which is right. Like the idea is in the same way that in medieval times you create a moat and it's there's this circular bog with some alligators in it, and I'll pull up the drawbridge and there's no way to get in unless you want to. It's hard to get a battering ram through a circular bog and then past the alligators into the castle unless you're as strong as Jack Farley.
Okay.
Right. And so that metaphor, as most of your listeners I'm sure know, is like for the idea of pricing power of for whatever reason, and the reasons, the details there matter, we can push price pretty darn hard before we get pushed back from consumers, maybe because our customer base loves our stuff so much and our product is just so superior.
Like Celsius.
Celsius is very good. Or maybe we've effectively acquired all of our competitors, right? So on and so on. And I think, again, it's this thing where there's very rarely one reason why some phenomenon is happening. But it was really frustrating for me to, on the one hand, hear a lot of giddy investors that thought, look, even in a bear market like we had in 2022, but before that, during that, and after that, there are a lot of people that were really jazzed up about the level of pricing power that, said company has, which would suggest an inflationary environment, at least in part, driven and or amplified by pricing power and market power, and maybe market power imbalances. Like, where have you stood on that? Right. So it's almost impossible to fully and neatly disaggregate how much market imbalances, corporate pricing power has played a part into what has been, at least until recently, a higher underlying inflation environment. Like, where have you been on that? Just to put my cards on the table, I think my rate to which market imbalances, oligopolies, corporate pricing power, like how much of a role that played in amplifying, not starting, but in amplifying inflation. I think my reporting, my analysis probably puts it at a higher level, higher percentage of the inflation that we got than some other folks. But like, I actually don't, like, this isn't just a bit for a podcast or whatever. I don't think we've actually ever talked that much directly about where you stand and what your interviews have led you to think.
Well, I think we talked about it a little bit on our car ride up to Maine. I think that pricing power is two different things. There's how much can a company price or raise prices for what it sells, and consumers will swallow it and gladly pay it because they love the product, or they can't get it anywhere else, or that company has a monopoly from the government or for some other reason. And then there's the reason that a company has pricing power because it's a booming economy and nominal growth is very high, inflation is high, nominal income and nominal spending is growing like one such as the 1970s. So I think that a company that has moat will outperform probably companies that don't have a moat. But all companies have pricing power in an economy where nominal growth is 8%, or they have a lot more pricing power than they do when it's at 2%, because people just have more money. I think they, then labor has pricing power too, and this is where you get to the wage price spiral. So I think it is about pricing power, but I think when you talk about corporate power and oligopolies, I think you're talking about the moat type of pricing power. And I think that a lot of companies that raised prices in 2022, if they had a moat, I think they probably had that moat in 2019. And they didn't raise prices by 10% in 2019, probably because they didn't have as much pricing power, probably because, not because they didn't have their moat, probably because people didn't have as much money. So I do think that you probably you attribute a higher level of companies raising prices to their ability to
well, it's always
have an oligopoly.
It's almost always and everywhere companies that raise prices. The question is, why are they doing it, right? I mean, prices are sold. Who sells things?
And I guess companies technically even do raise the prices of wages because they're the one who advertise wages. It's just that people won't take the wages if they're not sufficiently high.
No, that's fair. I would the one thing that I would push back on, and then I guess whatever we can wrap up, this has been great, is I learned a lot from my colleague, Jordan Holman, who's a retail reporter. Shout out to Jordan, just about the dynamics of just very specifically retail in the 2010s versus now. And one of the things that we sort of sorting out, and we actually did a story about, is just like how essentially large retailers like Dick's Sporting Goods to whatever, you name it, Sephora, the entire industry across a broad range of products they were locked into this prisoner's dilemma where, ideally you push price as far as you can while maintaining customer loyalty. But we're in an environment where they knew, if we do that, people will see our moves. They're listening to all our earnings calls. We're listening to theirs. We swim in the same circles. If it gets out that your strategy is we're going to push price a little bit harder, as long as your competitor pretty much is in the ballpark of the quality that you have in terms of your product, they're going to undercut your price and go for volume. And they truly were locked into that. And I think if you look at the retail ETF, I know there's probably more than one, but I'm forgetting the name. It's X something. Won't go for it. Three letters, X something. I was pretty much flat from, I think, 2014 to 2019. And that was indicative of, I think, those companies underperforming for that reason, even once the economy had healed, once the consumer had healed by the late 2010s. But what the pandemic did, in my opinion, in my analysis, is that it broke that prisoner's dilemma. And immediately everybody had very valid reasons to raise prices. Costs had absolutely gone up. But then it was the game of, okay, the whole point of doing a business is to have cost plus pricing. They're not nonprofits just looking to break even and maybe make a little extra and then put that in treasuries or something, right? The point of a business is to make money, and right, it's not just profits. Sam Rowe always points out, it's not just profits, profitability, growth. All of a sudden it was just like, oh my goodness, the doors, and they had an opportunity to, rather than undercut each other, to all agree that, hey, let's all make money here. And I don't think that necessarily, to your point about what counts as legal and illegal, I firmly do not think what that behavior, as far as I know, maybe the federal government will take somebody to court in the coming years and it turns out that according to Kotok, some of that behavior was illegal. I think maybe some of the meat companies did get into trouble, and that industry's a bit oligarch. But I do think that was a meaningful change, and I believe it was Barkin, who was the Richmond president of the Richmond Fed president, that was talking with a different journalist actually about a culture of inflation and how once it's normalized both to the customer and to other competitors that prices are going up, it's awfully hard to wind that back, even when input costs for businesses have chilled out.
That's why people think that you need a hard landing to kill inflation.
And that was when I was actually the most worried. I didn't think that margins would necessarily mean revert back to the 2010s, but I like Lael Brainerd that when she was at the Fed, even before she got involved in politics, being a part of this administration, I thought that was one of her good points about why a soft landing. And it wasn't just her making this point. She was pretty high up at the Fed, so I took her and others that were making this point seriously. Margin recompression was a clear, available reason for why we could have a soft landing and have inflation come down, have the labor market still be there, and businesses not making as much in terms of margin, still doing pretty well. If you talk to people like Sonny Varghese at Carson Group, he tracks PPI data very closely, and the PPI data shows you margins have actually expanded. I think by 23%, something like that. I'm sure it's changed. I'm sure maybe off by a month or two because I can't remember the last time I looked at this data series. But then I think that shows you like, oh man, only if you hear about an inflationary bout, you would expect that both businesses and consumers in the aggregate, and we're talking in aggregates here, they're both got the brunt of it. But if margins expand in the aggregate for businesses by a large amount in the way that they did, and I don't know whether we'll be able to pull up the Carson Group chart that shows this, then yeah, on the one hand, that was super bullish for hiring and for investors, because businesses that are making money hire people, and businesses that are making money, that's also good for people invested in those companies. But I think it was a bigger part of the reason that we sustain inflation. But I think the pushback that folks like you, and I don't even think it's not like you've been on a soapbox about this, but but even the way you just broke it down just now, it's like it's inherently reasonable to also talk about consumer price insensitivity, which was real and for some reasons came out of good reasons, like everybody's employed and getting raises.
Or we have a risk of a Great Depression, and the unemployment rate went from very low to extremely high very quickly. And we need to send people checks. I think if you have a problem with that's a political issue, but like you need to understand why a Republican administration hastily signed that into action, and then a Democratic administration expanded it in various forms. I think it's the Olympics just finished. It makes me think of it in a 5K race or a middle to long distance race when the runners are not running that fast, they're pacing themselves. But then once one of them breaks out, they all break out because they don't want to. That kind of sounds like it's the.
Was that your move? Were you a front runner, or would you try to suck people up with a vacuum them up at the end and pass them by?
I did both. My one thing was I wasn't speedy in my sprint. And so I had to struggle at very first to like get out as soon as possible, just because like people out of the gates, I would be very slow. I would typically, when I would run the mile, I would try and run the third lap hard, and I would kick early and I'd try and win the race. It was all about, by the way, when you say inflationary bout, I can't help. I feel like financial journalists or business journalists, they use a few phrases that like I feel like I've read in financial journalism and I've never heard anywhere else. Inflationary bout. Another one is snarled supply chain.
Snarled. Yeah, supply chains are always snarled.
And then sour loan.
Ooh, sour loans.
The loans have been sour.
Also, maturity wall is always looming.
Yes.
Always looming, those maturity walls. I'm waiting for something to loom small.
Yeah, they loom. I always loom big. They loomed, and then extended. Talking about credit, the high yield bond market has refinanced a lot of deals this year. The leveraged loan market has refinanced a lot of deals. Interest rates haven't gone down, but credit spreads have narrowed. So a lot of the CLOs, collateralized loan obligations, have refinanced. But Tal, we've given the people what they wanted.
We've solved the economy, basically.
Yes, in all future economic issues.
Yeah.
Let's leave it there. Where can people find you, and what is your Twitter handle?
My Twitter handle, I believe, is at Talmon Smith, Talmon Smith, how you think it would be spelled. Subscribe to the New York Times, read the New York Times business section, and all the great work of my colleagues, and occasionally me. And I am going to be doing a book sooner or later with Simon & Schuster. So I don't actually know why we haven't talked about that. But
I didn't tell us. Tell us what you can.
It's inherently focused on some of the ideas that we've been talking about on this afternoon drive. I guess it started in the morning, but now it's an afternoon drive, about identifying which issues in the economy are connected to uncomfortable truths, where it's like, hey, no, like there's really a constraint. Demand is not depriving you of utopia. It's actually just hard things that we have to figure out and balance, et cetera. And when are we facing economic issues that stem from noble lies, where either because it's useful or just generally advantageous to keep a status quo narrative and the status quo itself going for those who are in power, where that ends up leading to outcomes that are unnecessarily unfair, raising the baseline standard of prosperity, which I think everybody can basically agree the economy should, in an ideal world, be about. So I see myself doing what I normally do, which is traveling around the country, trying to find microcosms of economic situations that are representative of broader trends. This time, when I file 6,000 words for a chapter about something going on in some place that's representative of a broader trend, past, present, or future, my editor won't be yelling at me for why have you filed 6,000 words. The whole point will be to write chapter length. And so that's both somewhat daunting, but also fun. And I will, for anybody that follows me, I'll let people know about that, I guess, sometime this fall when it's like technically officially announced. But here's the soft, that's the soft launch. But yeah, I told you this before we started recording. I'm going to tell you now that you are recording. You have crushed it this cycle. You have deserved everything that has come to you and everything that will come to you. And yeah, man, like when you make it not just big, you've already made it big. When you make it super big, just don't big time me. Still say what's up when you walk by.
I'll never big time you. You're going to be on 2 podcasts, one, the Forward Guidance podcast, and another, or I should say, a large financial podcast. You're making the rounds, and we at Forward Guidance are honored you made the time for us on this 9-hour drive. And yeah,
Go back in one piece.
Yeah, sounds good. Thanks, Tal, and thanks everyone for listening.